I did not like all the mixed messaging we got on tariffs over the weekend.
We are getting some certainty. I just think markets haven't been liking the certainty that we're getting.
The more that Donald Trump seems to double down, the more investors think this is an unsustainable path forward.
It's not a sustainable situation.
If we continue along this current path of uncertainty, where objectives are not stated, it's going to continue to maintain, I think, an unhealthy level of volatility for the markets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday, looking for a third day of gains as the president considers more exemptions.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places. And they need a little bit of time because they're going to make them here. But they need a little bit of time. So I'm talking about things like that.
The White House offering some support after policy volatility shakes up global markets. The Treasury Secretary downplaying the recent sell-off.
Even the president recently remarked that the bond market was, quote, queasy. Do you have a sense of who is dumping U.S. assets? Who's been dumping U.S. treasuries?
I don't think there's a dumping, and I think we saw in the tick data either today or Friday that actually foreign ownerships picked up. I think a lot of people got very leveraged, maybe out over their skis.
So you don't think it's sovereigns, potentially it's hedge funds unwinding?
I have no evidence.
The Treasury Secretary, Scott Bessent, helping to put a floor under fragile bond market confidence as questions continue to linger over U.S. assets. The latest fund manager survey from Bank of America showing 73% of respondents say U.S. exceptionalism has peaked, and a record number of investors intend to cut U.S. stocks. The dollar struggling to avoid a six-day losing streak.
What is interesting is you are getting a bit into treasuries. If you want some comfort, that is the place to have comfort. The other bit of comfort is that Bank of America fund manager survey that you cited really does highlight how much the contrarian trade now is to go into U.S. assets. Look, it is important to remember that we just saw, yes, the first back-to-back gains in the S&P going back to April 2nd, but we were only 10% below or 12% below the mid-February peak. So, yes, we have seen a pretty big drawdown. At the same time, it's not the catastrophic bear market types of feelings that we had maybe, I don't know, 2 days ago.
The survey's pretty phenomenal from Bank of America. Just to go through those headlines, if you are just joining us, welcome. The fifth most bearish in the past 25 years. The fourth highest recession expectations of the past 20 years. And the outlook for the US dollar and profits, the worst since 2006, 2007. Lisa, is it that bad right now? Is it that bad?
All of the soft data seems to confirm this type of sentiment. We have seen that in the University of Michigan Sentiment Survey. We have seen that when it comes to even the AAII investment sentiment surveys. We have seen this feeling that there is a regime change that you cannot see. That said, the hard data continues to be strong. We get bank earnings, the commentary from all of the bank executives. We're not as worried, at least about ourselves. We could see deterioration. So at what point do these things add up? Does the uncertainty that nobody likes translate into actions that investors really don't like? So
it's not shown up in a material way in the bank earnings, and we'll hear from Bank of America later this hour. We talked about this yesterday. Goldman raised the buyback up to $40 billion. That's a display of confidence. JPMorgan raised their outlook. That's a display of confidence. Can United Airlines do the same thing a little bit later when we get earnings from them?
A bit of a different story. Certainly we saw from Delta a bit of a different story, although you could still get share buybacks if they believe that they are undervalued. They are expected to sort of underperform some of the expectations. But at this point, that is a good question. How much strength do they have given the resilience that you have seen in the consumer so far based on trying to gird for what's ahead, which is an expectation of a real big slowdown, particularly among domestic travel?
Just a little bit of stability at the moment in the equity market. Equity futures so far positive by, let's call it, 0.2%. Coming up on the programme, we'll catch up with Mueller-Glissmann of Goldman Sachs with stocks on a two-day winning streak. Terry Haines of Pangaea Policy as Trump offers autos some support. And Ken Leon of CFRA reacting to earnings from Bank of America. We begin this hour with stocks higher as President Donald Trump floats a potential auto tariff pause. Mueller-Glissmann of Goldman Sachs writing, we remain defensive tactically as markets continue to reprice recession risk near term. But we are shifting more neutral across assets for 12-month horizons. Christian joins us now for more. Christian, welcome to the programme, sir. Let's just go through these headlines that we got from the fund manager survey from Bank of America. Super bearish. The fifth most bearish in the past 25 years. Do you think things are that bad right now?
No, not really. I think to some extent there's a lot of bad sentiment, and that's helped the market recover. I think last week, at the beginning of the week, our risk appetite indicator went intraday on Monday to -2. I mean, that's extreme bearishness. That's very sharp moves, and that was a lot related to this uncertainty around tariffs. But I think since then, I think there's been a decent amount of relaxation. And if you actually look at like risk pricing across assets, I don't actually think there's that much bearishness in markets right now.
Christian, do you think there should be? Do you think we should be pricing in a deterioration in the economic data? Are you anticipating that in weeks and months to come?
Yeah, I think the challenge is like there's always three cycles we try to understand. The sentiment cycle, the business cycle, the structural cycle. So the sentiment cycle was incredibly bearish at the beginning of the week, last week. And I think that kind of created this temporary rally because you had like peak tariff uncertainty, at least in the investors' minds. But the challenge is we still need to deal with the business cycle and we need to deal with the structural cycle. The business cycle is deteriorating. According to our economists, you're going to have weaker growth kind of to the extent that recession risk is still 45% in the US. You're kind of close to zero in terms of growth. And well below trend. So you need to rebuild risk premium for that. But also you have that inflationary element of the tariffs, which might constrain the central bank put. You see the longer-dated bonds not buffering for all kinds of reasons. So I think the business cycle to us is still quite challenging. And then you mentioned it earlier, there's the structural cycle concern about US exceptionalism. And I think the market is currently making a major potential reassessment of valuations of US assets. So both those things make us a bit concerned about the kind of near-term picture on risk assets.
You said that for the sentiment cycle, we reached peak tariff uncertainty in the past week. What makes you so certain that we've reached peak uncertainty and we've passed that point?
No, I think this is what the market is hoping to some extent. You had like this incredible uncertainty coming out of the weekend going into Monday with the enormous volatility you saw then. And since then, I think the tariff news flow has been a bit more specific, a bit more de-escalatory. And to some extent, the way markets work, obviously, is always the first time you have a shock, it's the worst. The second time you have the same shock, it gets less bad. So I think the speed on uncertainty, sell-offs related to tariffs might come down from here because you already kind of had a major shock and it's being de-escalated. But also now we're starting to understand those shocks a bit better. So I would say like the tariff uncertainty might not be as big of a driver of sentiment as the actual data. I think now the business cycle, growth, inflation, policy, and to some extent the structural cycle will probably take over as a driver of sentiment.
So, Christian, this brings me to why you see the structural and the business cycle issues as being less bad than the market might be pricing in. The fact that you moved from defensive to neutral over the past couple of days, even with some of these hanging concerns with respect to U.S. exceptionalism, with respect to the potential souring in the economy.
Yeah, I think the important thing is the baseline is that we don't get a deep, lasting recession in the U.S. So from that perspective, you've had a decent drawdown, and we shifted essentially a bit more neutral after that drawdown, if that makes sense. So for medium-term investors, you have to consider, do you actually expect a deep, cyclical bear market or possibly even a structural bear market? And if not, you might want to use those opportunities to dollar cost average. And while we're neutral with regards to the broad asset complex, we're overweight cash to kind of moderate to some extent risk, because in a stagflation type backdrop, the equity bond diversification doesn't work. So we don't want to necessarily carry on this very risk off allocation, which we currently have, which is overweight bonds and underweight equities over the 12-month horizon. I would agree, though, you have to be careful about structural losers. So when you think about like the 12-month horizon, the structural cycle will potentially matter. And if we do see corporate profitability in the US, especially for these large cap capital light business models, start to come down, you want to avoid those areas, the most highly priced areas of the market, when you start to think about re-risking.
Krishna, are you talking about big tech?
Well, yeah, I think we have to be completely honest. It's been 15 years where big tech and large cap capital-light business models have driven up U.S. equities, U.S. equity valuations because of rising corporate profitability. We wrote about this in our research. The combination of low and anchored inflation coupled with rising return on equity can explain a lot of the valuation advantage that U.S. equities have versus the rest of the world, but also relative to their own history. So if you now see the tariffs push up inflation and weigh on corporate profitability for those capital-light business models, I think you have a bit of risk that valuations are coming down a bit.
Could you explain the kind of equity exposure that you are comfortable taking and where it might be?
Yeah, I think like right now we're definitely focused on international diversification. It's a big topic. You have to be careful, of course. You always wonder, like, where would you want to go, if not the US, after 15 years of that outperformance. So we're very focused on, obviously, themes like infrastructure, real estate, real assets that potentially can do better in the world of stagflation. And compared to 2022, when infrastructure and real estate actually didn't do that well because of the aggressive Fed tightening and these places being a bit more levered, maybe that risk is a bit lower. So these areas could actually do a bit better, a bit more value-ish. And the other area is low volatility as a style. We've been very focused on low volatility across the regions as a way to potentially introduce safety in the portfolio when the bond market doesn't buffer as well as it did, for example, in 2024 when you had the growth scare.
That raises a question, Christian. In a stagflationary environment, does 60-40 die?
I think die is a bit strong, and I would certainly argue that starting point matters. Like in 2022, US 10-year yields were at 1.5% and they went above 4%. I think if you look at current US 10-year yields, they're in a much better spot to some extent not have that negative convexity which you had in 2022. And I think unless you really see inflation go up like in the 70s, where you went to 10%, I think like you're in a very different spot. Like our economists expect core PCE inflation to go to the mid-3s and then linger there a bit and then come down, considering that the tariff shock theoretically should be a bit like a one-off. I think we're dealing with a much softer form of stagflation, where 60-40 would not necessarily be as badly impacted as in 2022. But I would certainly argue that it won't work as well as we are accustomed to as a generation of investors. What I would say, though, is that international bond diversification can work. And if you actually look in the last 2-3 weeks, like German 10-year bonds, even Japanese 10-year bonds, they did a better job than treasuries in buffering equities. So you can do things to make the 60-40 portfolio work a bit better by going international in terms of diversification.
Christian, appreciate your time, sir. As always, Christian Mueller-Glissmann there of Goldman Sachs out of London this morning. The #1 crowded trade in the Bank of America Fund Manager Survey, long gold. Speaks to the question that you're asking.
How do you diversify? We also have heard this incredible diversification outside of the U.S. into other markets. I just want to say this. There's a little bit of out of the fire into the frying pan with this, because if you think about Germany and Japan, they both are engaging in potential fiscal stimuluses that could potentially pressure their bond markets too. So it isn't such a clear picture, and I'm smiling because there is this question of what diversification means when it's not a stagnant picture. These companies, these countries are all taking moves of their own.
We've had a few days of stability in the bond market. Let's hope it continues. It's going to take a number of days, weeks and months to really put to bed the idea that we're questioning the safe haven status of the United States. But Annmarie's interview with Secretary Besson yesterday, I think, goes to some way to express where the Treasury Secretary's at the moment and how he considered the moves of the past week or so.
It sounds like he looks at this as really leveraged trade unwinds or just something that's more technical. He says that he's looking at tick data. It is backward looking, just to point that out, in terms of foreign investor demand. But we heard that from Bob Michael, also of JPMorgan Asset Management. It is more than a couple days that will remove this theme that U.S. Treasuries can be a haven.
Bond yields higher by just a single basis point this morning, just short of 440 on a 10-year. With an update on stories elsewhere with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. The Trump administration announced that it launched probes into semiconductor and pharmaceutical imports earlier this month. It's a move that could lead to new tariffs on the sectors. The probe, being led by the Commerce Department, is investigating the impact of the imports on U.S. national security. Elsewhere, China has ordered its airlines to stop taking deliveries of Boeing jets. Sources tell us that Beijing also asked carriers to halt purchases of aircraft-related equipment and parts from U.S. companies. The Chinese government is also considering ways to assist airlines that lease Boeing jets and facing higher costs. Hermes briefly surpassing rival LVMH in market cap, making it the third largest company in Europe as LVMH saw disappointing China and U.S. sales. The move indicating the still independent luxury brand as it weathers a recent downturn in luxury demand and after it shunned an LVMH takeover over a decade ago. And that's your brief. John.
Danny, thank you. Those numbers not great. Down 3% in the US, Lisa, down 11% in China. The only bright spot was actually Europe.
So this raises a question, is it luxury or is it loud fashion? Is it a misstep in terms of planning, which I'm sure Annmarie and yourself could probably tell me more than I really could give insight on. But there is this larger question of the Chinese exposure that a lot of these luxury brands have.
I'll let Annmarie address that when she gets back tomorrow. Up next on the programme, the President considering some relief.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places. And they need a little bit of time.
We'll get you the latest down in Washington, D.C. in just a moment. We'll catch up with Terry Haines of Pangaea, live from New York City this morning. Good morning. Equity futures just about positive. The first two-day winning streak on the S&P since April 2nd, Liberation Day. Just put that together in yesterday's session. Can we make it day three? Up by 0.2% on the S&P. On the Nasdaq 100, up by a little more than 0.25%. Under surveillance this morning, the President considering some relief.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places. And they need a little bit of time because they're going to make them here. But they need a little bit of time. So I'm talking about things like that.
So here's the latest this morning. The Trump administration mulling possible temporary exemptions for automakers, buying time for companies to bring manufacturing back to the United States. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome to the program. At the same time they're considering offering support, they're also considering more tariffs. Is that right?
Yes, John, good morning. Well, more tariffs, particularly when it comes to some of these other sectors, including pharmaceuticals as well as semiconductors. This administration has formally launched a Section 232 investigation, which would then very likely result in tariffs being implemented on the basis of national security concerns. And we should say that these probes are actually rather large. They include pharmaceuticals, but also the ingredients that go into pharmaceuticals, as well as those chips, but also the equipment that's used to make chips, as well as those downstream products like consumer electronics that have the chips within them. Now, when it comes to what this potentially could look like moving forward, President Trump has said that he would be open to some exemptions, particularly when it does come to those chip products that he would be looking at, but has yet to specify exactly what would be in it. That relates to what you're talking about when it comes to these potential auto tariffs, with President Trump saying that he would be looking at some sort of temporary relief for those car makers who would move auto part production to the U.S. We have to keep in mind that the auto parts have long been sort of the tricky part of the equation here because, John, the U.S. has said that we will not tariff U.S. content within the parts, but it's getting increasingly difficult to decide between what is U.S. content and non-U.S. content within auto parts because all of these supply chains are just so highly integrated.
Tyler Kendall with the latest down in Washington. Tyler, thank you. Lisa, here's the situation for me. If you're a company at the moment, you're spending more time trying to secure an exemption than you are moving a supply chain. That's probably not a great position to be in.
Well, it also suggests that there has been real confusion about what the goal is and how they can get these tariffs through and under which provisions, given the fact that they started with the bazooka, no exemptions. Remember, there were no exemptions. Then there are lots of exemptions, and now line up and get your exemptions because we recognize that there is time. Which is it? And how much does this undermine potentially their arguments about emergency action?
Terry Haines of Pangaea Policy joins us now for more. Terry, welcome to the programme. The administration, I think, has done a very good job. I think President Trump's done a good job of articulating the problem for a number of years now, going back decades, the remedy to the problem and the execution of that remedy. What's your reaction to that over the past few weeks?
Well, it's been scattershot, Jonathan, frankly, and good morning, both on strategy and execution. But, you know, if there's a consistency in the Trump presidencies, I think what you can see is that what he tends to do is kind of go big, bold, clear, motivational and then start embroidering off the exceptions and the like. And that's certainly the pattern now. I want to be very clear about the direction we're moving in terms of, what we're manufacturing, where we're manufacturing it, how we're doing it. But then, we're going to wait to have the industries come back and separate the wheat from the chaff on what's legitimate and what's not. So it is a difficult process for everybody. I understand that, and it's a very difficult process. And at the same time, that's how they operate.
John has asked this question many times. Who are they negotiating with? And yes, they're negotiating with themselves inside the cabinet. They're negotiating with companies. They're negotiating with countries. And they're negotiating with a market. Terry, how does that complicate understanding exactly how to get to the goals that they ultimately have laid out?
I think what they end up doing is they prioritize those overlap, but they're not completely congruent. You negotiate as best you can with the individual countries involved, and again, push forward bilaterals. Get your best results. Move on. Get some future promises as well. Move on. The cabinet understands that at the end of the day, the president's the decision maker, and so they fold in around. And as to the rest, these companies, by and large, that we're talking about today are big companies that have, among other things, pretty sophisticated lobbying operations, and they're fully engaged as well. So,
yeah. Last night, Annmarie talking to Treasury Secretary Scott Bessent. Scott Bessent had a message. He wanted to talk about the three-legged stool of policy, and that tariffs are one wing of that, one leg of that. And then you had deregulation, and then you had some of the tax relief and what was getting passed through Congress. Those other two legs of the stool have been called into question recently in terms of how big they can be and how much they can offset some of the concerns over the tariffs. Do you have a sense of how that's going?
Well, I have tax cuts at 80% likely to happen in the fourth quarter of calendar 2025, and I think there's a rising possibility that it happens sooner. It's not for nothing that that Trump picks July 4th as the day on the next direction on tariffs, and they'd very much like to goose Congress as fast as they possibly can to get the tax cuts in place for the third quarter as well. So. But I'm optimistic that the Congress gets this done. There's an awful lot of alignment on that. As to the numbers, what the Senate and the House are talking about is something on the order of $5 trillion in tax cuts over 10 years, without a lot of offsetting. Without a lot of pay-for offsets, and the reason for that is they've chosen, as I've been talking about for a while, this current policy baseline that allows them to do that. So, what you're going to see is a very big tax cut number coming through, I think, and I think that probably balances or more the tariff shocks.
Terry, you think they go beyond extending existing law?
I think they do in some respects, in part because that's what Trump's wanted, these tax on tips and, the salt business, all kinds of things they need to do in order to get votes and get a signature into law, number one. Number two, they're going to have to change the tax code for a variety of things, including providing additional incentives for reshoring and onshoring manufacturing. So I'd look for all that.
Terry Haines, appreciate the input. Thank you, sir. Terry Haines of Pangaea Policy on the prospect of Liberation Day from taxes. On July 4th? No, doesn't work.
I think that works. It's Happy Tax Day, just for everyone who hasn't filed yet. Today is April 15th. I am curious about how much he can get through, given the fact that right now the bond market is yippee and fearful. And how fearful and yippee will it get if you start talking about further deficit expansion like that?
Secretary Bessent wasn't yippee yesterday with Annmarie, that's for sure.
No.
I love the question on the Federal Reserve. The interviews are going to start later in the fall.
Yeah.
Does Chairman Powell get an interview?
That's a great question. It also signifies that they're not going to boot him from his position because they would have to be doing it for early next year. I also like the idea of an away game, that it's a home game or away game when it comes to their meetings.
I think after Governor Waller's speech yesterday, I think maybe he gets an interview.
Oh, I think he's really gunning for one, so,
yeah.
Hopefully
we'll get what he wants. We'll talk more about that in just a moment. Up next on the programme, Sonja Marten of DZ Bank as Secretary Bessent defends the dollar. 2 days of gains on the S&P 500, attempting to make it day 3. Equity futures on the S&P positive by 0.2%. Moments ago, a super bearish fund manager survey from the team over at Bank of America, the 5th most bearish in the past 25 years, the 4th highest recession expectations of the past 20 years, and the outlook for both the US dollar and US profits rated the worst since 2006, 2007. More on that coming a little bit later. With 3 hours until that opening bell, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. One of the big movers to the downside this morning in the pre-market is Boeing after a great Bloomberg scoop from the team that China has told its airlines to stop taking Boeing deliveries. Those shares down 3.1%. You also see some of the American suppliers falling this morning because that extends also to supplies coming out of the U.S. It's an important market for Boeing. About 18% of its revenue comes from China. Now, to the upside this morning, we're looking at Netflix gaining in the pre-market session nearly 3%, 2.8%. This comes off the back of a late in the day Wall Street Journal story yesterday where sources told the Journal that Netflix had a business meeting, their annual review, last month in which they set some really lofty targets. They want to double their revenue by 2030, and they also want to achieve a $1 trillion market cap by that point. Just to put in context, they're just below $400 billion in market cap now. Rounding things out with some earnings out moments ago, coming from J&J. Johnson & Johnson was higher when they initially reported earnings, up some 1% because it was a hefty beat across the board. We've paired some of that. Maybe it has to do with the concern about pharma tariffs to come. But the CFO speaking to Bloomberg about the investigation by the Commerce Department, saying that they think it could be a good thing. It will show that they're not a national security threat, making them immune from further tariffs. Also saying perhaps it will keep some of the cheaper generics out of the market. John.
Danny, thank you. Appreciate the update. On our radar this morning, our top story, President Donald Trump initiating probes into semiconductor and pharmaceutical imports, moving one step closer to imposing tariffs on the sectors. The investigations kicked off on April 1 and could play out over the next several months.
So how do you pair this with some of the overarching tariffs that have already been put on? Was it basically to get some sort of sense, we can get 20% right now while we figure out the sectoral tariffs? Do those then come off and the sectoral tariffs come on? How much negotiation, how much room is there for Tim Cook, for Mark Zuckerberg at a time when potentially their businesses could take a catastrophic hit?
If you'd asked me a few weeks ago, I would have said not much. And then after the events of the last week, I think there's space. There's room for them to make an effort to secure exemptions based on what we've seen over the last couple of days and what we've heard from the president directly.
So there's a Trump put. That's what a lot of people are wondering. What is the contour of that? What are the contours of that Trump put? Is it the Treasury market potential dysfunction? Is it this question around how much tech giants sell off and the idea of the U.S. possibly losing some of its dominance to China should some of these go through? That's one big question here. Where are the lines of argument that these companies can really take?
The put never went away. We just tried to figure out where the strike price was. I think we figured out over the last week. Likewise for some officials on the Federal Reserve. What's really interesting about Governor Waller, and we mentioned him a little bit earlier, he came out very early and downplayed the possibility, the potential that tariffs would lead to higher inflation and second-round effects. He did that a number of weeks ago. What he did yesterday that I thought was really interesting, he didn't stick to script. The rest of the Federal Reserve has come out and pledged to anchor inflation expectations. Front and centre. He's come out and basically turned around and said, if we threaten economic growth, or if we threaten to go into recession, I'm going to cut and be willing to cut much more. Now, he's differentiating himself from the rest of the committee. I'm not going to sit here and say he's running and he's going to be the next Federal Reserve chair, but I think that's certainly an attractive option for this White House right now if they were looking at potential candidates on the FOMC.
He took the framing away from the dual mandate of inflation versus unemployment. And the other Fed officials talked about how inflation was number one, and then they could talk about stabilizing employment. He called the new tariff policy, Chris Waller, one of the biggest shocks to affect the U.S. economy in many decades, and said the future of that policy, as well as its possible effects, is still highly uncertain. This makes outlook also highly uncertain and demands that policymakers remain flexible in considering a wide range of outcomes. Is he speaking to some of his colleagues or is he speaking to the market?
Who knows? Is he speaking to the White House?
Exactly.
We'll find out. Secretary Besson talked about interviews taking place later this fall, and we'll see if Governor Waller gets one. China, this is how they're responding. Ordering its airlines not to take any more deliveries of Boeing jets. Sources telling us here at Bloomberg that Beijing has also asked carriers to hold any purchases of aircraft-related equipment and parts from US companies.
So The idea of escalation, have we really taken that off the table, or is escalation going to look much more targeted, much more deliberate coming from China, putting pressure on specific executives to go to Washington, D.C. and lobby President Trump for possible exemptions? How much is this the long game for China at a time when they aren't going to necessarily escalate with just simply raising tariffs that much higher? Look, it is so hard to track every morning where we are in this tariff whack-a-mole. You know, you smack one down, another one pops up over there, and that's kind of, you know, different elements of this trade war have been ongoing.
Based on the estimates I've seen, effective tariff rates are now at triple digits on both sides of that trade relationship between the US and China. So what's left? What's left is stuff like this. You basically just tell companies to stop buying, full stop.
What's the goal, though? Because from China's perspective, this is a significant part of their jet supply. So is the end goal to ratchet up the pressure on specific people who might get an audience with the president? That seemed to be what the Europeans were trying to do with going after particular Republican states and the economies there. So is that the modus operandi of China right now?
Let's talk about some European companies as well, Lisa. MS, if you look over in Europe today, briefly surpassing LVMH in market cap, making it the most valuable company on the CAC 40 index and the third largest listed company over in Europe. This coming after LVMH delivered some very disappointing results overnight on slowing demand in both the United States and in China.
What's been interesting is how much Hermes has been the outlier. Evidently, scarves never go out of fashion, and LVMH and Hermes has benefited from a more timeless look that hasn't gone out of style. I wonder how much signal we can take about the wealthier investor, the wealthier consumer, and how much they actually are retrenching, how much Chinese consumers are retrenching, or whether it's a winner-take-all kind of moment, where suddenly the strongest players across the board are going to be the ones consolidating their market share, or is it an element of both?
That's my question for United Airlines later. Long haul and premium, is it holding up? Because that's what's been holding up this economy now for quite a while. The upper-income workers in the United States, the low-income workers have been squeezed for years. They haven't enjoyed this cycle at all. We've seen that in survey after survey consistently. It predates this administration. We saw it throughout the Biden first term. And I just wonder if that starts to show up in the earnings a little bit later.
Big question, considering how much that's driven the cycle. And for people who say, take out your tiny violin and start playing it for the wealthy consumers and whether they're actually pulling back on spending, it's not about that. It's not about feeling bad for people. This is about questioning the pillars of consumer support for a U.S. economy and questioning what that means in terms of how long that can continue to power all growth.
Earnings from United coming after the bell later on. Let's talk about foreign exchange. The dollar struggling to avoid a 6-day losing streak. The U.S. Treasury Secretary Scott Bessent pushing back against any concerns.
You're not concerned at this moment about the U.S. dollar or the U.S. Treasury losing safe haven asset?
No, we are still a global reserve currency that we have a strong dollar policy. If you go and look back at President Trump's first term, I don't remember the exact number, but the dollar in 2017 went down, and then once the tax bill was done, took off.
Over the last week, the US dollar under pressure amid shifting tariff policy, briefly falling to a 6-month low early this week. Sonja Marten of DZ Bank joins us now for more. Sonja, welcome to the programme. Let's just talk about what's driving the dollar weakness over the past several months. What's behind it? What are the number one pillars of that trade at the moment?
I actually think that the narrative has changed a bit if we look back. So it started off with the realization that Trump was going to make good on his promises to introduce harsh tariffs almost right away. So that dampened, economic sentiment, that raised fears in March of a Trump session. More rate cuts were being priced in from the Fed, and that drove the dollar lower initially. I do think that the latest bout of dollar selling that we have seen has a bit of a different flavor to it. And I would say that for the first time in a very long time, the safe haven status of the US dollar is actually under threat. I think, we have seen this before that people talk about it, but my feeling very much is that it has never been quite as serious as it is right now. And this really shows in the market reaction. We had a bit of a pushback or take back on tariffs recently. It has calmed the market down, but we haven't seen the dollar rally as a response in a relief rally, which one might have expected otherwise. And I think that really goes to show how much damage has been done in recent weeks here.
Sonja, what technicals are you looking at to give you a sense that this is real, the idea of the erosion of the dollar as having a haven status?
Well, I think, first of all, when you look at the last few weeks, we've had some real risk-off moves, and we look at other assets, other asset classes. It was very clearly unilaterally a risk-off move. Equities down, risk-sensitive assets down. We had safe haven flows in the Japanese yen, in the Swiss franc. So in that environment, you would normally expect the dollar to rally, and it obviously didn't. It actually went down quite significantly. And also, when you look at the U.S. Treasury market, again, here you see that the Treasury yield actually went up in response to this risk aversion sentiment in the market. And both of these very much, I think, confirm that there's something afoot, something is changing.
That said, Sonja, a lot of people are arguing that this is actually a leveraged trade unwind massively. And we've heard about some really big losses at some macro hedge funds. And there's this question of how much this is a move that has been given a narrative versus a narrative that has resulted in the move. How do you separate those two?
Normally I would be absolutely on the side of those arguing that this is more as an explanation, an ad hoc explanation for a move that we've already seen. I mean, I've always been quite vocal in saying that, all these stories about the era of the dollar coming to an end are overdone. And in the past, I absolutely believed that. But my sense right now is that it's more than that. And I mean, I don't think it's just the narrative. The problem is that there is a story behind that narrative. I mean, we're talking about Donald Trump, the president who, in his first few months of office has done many things that maybe we would have considered almost unthinkable beforehand. And I think the problem is this drives massive uncertainty. I mean, at this point, what do we want to rule out? I mean, let's take the Mar-a-Lago Accord. I mean, the idea of forcing investors in U.S. Treasuries to give up their, interest-paying bonds in favor of non-interest-bearing century bonds, that's almost ludicrous. And I think with this uncertainty and this sort of feeling of anything could happen, I think that's what's damaging the dollar and dollar sentiment right now.
So, Sonja, what is the alternative? You need a deep market with lots of liquidity, a reliable issuer with stable policy. What's the alternative?
Yeah. Well, that's the big problem. I mean, when you look back, I mean, we have this sort of codependency that's evolved over centuries, decades, sorry, not centuries, but decades. We have the U.S. depending very much on foreign capital. So the U.S. has been dependent on that source of money coming in. And on the other side of that equation, you have foreign investors who've built up massive amounts of treasuries or dollar assets. And because they're sitting on a big pile of these, it's very difficult for them to leave. So the thinking so far has been, it's too painful to leave, because let's imagine China were to announce, we're going to divest U.S. treasuries, we're going to sell out. That's going to immediately result in a massive increase in UST yields. It's going to damage the still existing portfolio China, for example, holds. So it seems a bit like a codependent situation. I think the question now becomes is what's more painful, staying in that dependency or making a hard cut? And I think that's the thinking that's driving investors to question old traditions of safe haven dollar assets.
Debates that are taking place right now in investor committees all around the world. Sonja, appreciate your time. Sonja Marten there of DZ Bank on the latest. What is the alternative? I'll tell you what the ultimate test is. If you get a bad jobs number, some bad data this week, retail sales, do bonds rally or do they sell off? That, for me, is going to be the ultimate test. Has it still got that haven status in times of difficulty in financial markets?
That's a fantastic test. Take it a step further. Nature is healing. With some time away from the leveraged trade unwind, supposedly, if we don't get material dollar strength and if we get the ongoing sell-off in treasuries, all of a sudden you have to think maybe something else is afoot.
That would spook people, that's for sure. Equity futures at the moment just about positive, and in the bond market some stability in the last 24 hours. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Several small businesses have sued President Donald Trump over his tariff policy. They argue that his use of the International Emergency Economic Powers Act is unconstitutional, and that, quote, trade deficits are not an emergency. The White House responding, saying that President Trump is, quote, standing up for Main Street. Elsewhere, NVIDIA plans to produce as much as $500 billion worth of AI infrastructure in the U.S. over the next 4 years. NVIDIA started producing its advanced Blackwell chip at TSMC's new plant in Phoenix. NVIDIA is also working on key partnerships to build supercomputer plants in Texas, alongside packaging and testing operations in Arizona. And a Blue Origin rocket that sent an all-female crew to space included pop star Katy Perry, Gayle King, and Jeff Bezos' fiancée, Laura Sanchez. The flight lasted roughly 11 minutes, and Perry sang Louis Armstrong's "What a Wonderful World" as the crew looked at the Earth. This is the first time in 60 years that an all-female crew has flown to space. And that's your brief. John.
Danny, thank you. Just getting some earnings from Bank of America. So net interest income comes in at $14.44 billion. The estimate, 14.36. A line that Lisa was looking for, provision for credit losses. Lisa, that comes in at $1.48 billion. The estimate, 1.53.
This to me is fascinating. Provisions for credit losses. The fact that it came in lighter than expected. We saw that similar from PNC earlier this morning with provisions for credit losses also coming in lighter than expected. Where lies that downturn that everyone was talking about that the banks discussed possibly girding for?
The stock is up by 1%. It's a beat also on trading revenue. Up next on the program, the big banks embracing volatility.
Trading in all of the big firms in equities was better than expected. The banks have always pointed out to us in trading, volatility is their friend.
And apparently volatility is Bank of America's friend as well. We'll talk about those numbers in just a moment. Ken Leon of CFRA is just around the corner. It's another beat on Wall Street. This time it's Bank of America. An upside surprise on trading revenue and net interest income. That stock is higher by 1.5% in the pre-market. Under surveillance this morning, the big banks embracing volatility.
Trading in all of the big firms in equities was better than expected. The banks have always pointed out to us in trading, volatility is their friend. Because of the volatility, they get very active in facilitating trading for their clients. And in doing so, it makes it very profitable for them.
It's certainly the friend of Bank of America this morning. Let's get you the latest and cross over to Bloomberg. Sonja Basak. Morning, Sonja.
Really clean read you're looking at Bank of America. Of course, we're seeing net interest income only not come in line with expectations. If you look through the presentation, they also held their full year expectations steady, John. If you look a little deeper, the expectation actually implies 4 interest rate cuts this year. So the question for investors becomes, could it actually be more than investors are currently looking for Bank of America to make this year? Coming into this print, Bank of America was trading more cheaply than the other banks, barring Citigroup. So they were trading at book value. Even Wells Fargo was above this. And if you take a look, not only were the consumer businesses very clean here, as Lisa had mentioned earlier, those provisions for loan losses coming in line with expectations, as well as flat from a quarter ago. So it didn't change very much. The commentary from Brian Moynihan here, very interesting, because he didn't really speak to the idea of tumult, more so just the expectation of a changing economic environment. So trying to keep the tone level set. I would also say something interesting for the people who are watching closely for the consumer loan performance. They did seem to break out the performance of the different loans differently. So you can take a look here. We know that Bank of America, the average FICO scores tend to be a lot higher than many of the smaller banks out there, but you can see how much of them are below 660 as well. And in the credit card business, that's about 12% of the book. So clearly Bank of America trying to guide folks to what the credit quality looks like underneath the hood as they keep trying to eke out more in net interest income.
The stock is higher in the pre-market by 1.5%. Sonja, stay close. We'll catch up with Sonja in about 60 minutes from now. About 70 minutes from now, you'll get the numbers from Citigroup. On credit quality, just to pick up on Sonja's thread there, Bank of America's Brian Moynihan, the CEO, saying consumers maintained a healthy credit quality. Let's get over to Ken Leon of CFRA about that. Ken, welcome to the program. What have we learned about credit quality in America in this banking season?
So I think what Brian Moynihan's going to speak about is his comfort zones, which is really Main Street, the consumer and small business. And what we saw in the release today is that credit risk committees make decisions on the current environment, not the forward environment. So that's credit. Again, the results are more stark in terms of the high volatility, the benefit for trading. Bank stocks never get rewarded in terms of multiple expansions for trading profits, but it shores up the full year. Second quarter is going to be choppy. It's really kind of like the beginning of COVID, where analysts like myself looked to the second half of this year. Is it V-shape or U-shape? We're optimistic. We think the capital markets are going to be open, but it's going to be the second half of this year. And what we're seeing is institutions and fund managers realign their portfolios, and that's good for equity trading.
Will it be a V shape? Will it be a U shape? Or will it just be a straight line? Because I don't see a dip right now. I mean, talking about the fact that you're getting healthy credit quality pretty much across the board. That's the message from Bank of America. PNC, a smaller but the biggest regional bank, came out earlier this morning talking the same kind of tone, that frankly provisions for credit losses came in lighter than expected. Does this make you more excited for the forward look for banks?
I don't think the story is credit here. It's way too early. It's really what happens in the capital markets and what is confidence for CEOs for capital raising. So again, the second half of this year, if it's going to be stronger, it's not the worries about credit. It's really going to be what happens in the capital markets. Clearly, if there's going to be any severe recession, then it's game off, and then we can start talking with red lights for credit. CFRA, we look at every metric of every bank on delinquencies, loan loss provisions, and reserve build or reserve reverse. We're just not there yet.
Going forward, can you still get optimistic about the banks if M&A doesn't revive, but you do have credit quality that hangs in there and you have yields that are higher than previously?
So the large banks are formidable. They have, as Jamie says, fortress balance sheets. They are formidable in their industry. And we have never seen an equity market outperform without financials and banks coming along for the ride. We're overweighted in financials. We would say to you, from 2007 versus 2025, when you look at the top 10 constituents of the financial sector, banks being a big part of it, they're a little less cyclical, they're more stable. And companies like Goldman Sachs with David Solomon talks about moving to more durable recurring fee revenue, whether it be in asset or wealth management or more principal investments in areas like alternatives. So the banks are very different than when we had this discussion back in 2007 or 8. And again, they're not the problem. So again, we'll see what Scott Bessent sees in the market and advises the president.
Again, there's a difference between existential risk and a recession, though. Do you really think they'd perform well in an economic downturn?
I'm sorry, I think when you look at the economic outlook, again, Goldman yesterday noted that they're now still positive, but it was above 2%, 0.5%. There's also the question on duration and also just a technical definition of recession versus a recession that hurts the consumer. And President Trump will pay attention to that.
Ken, appreciate the update. Thank you, sir. Ken Leon of CFRA. I've always been frustrated with that, and no offence to Ken. This idea that you sit here and say it's not 06, 07, that doesn't mean we don't have a problem. And I think you're on the money. When people talk about V-shaped recoveries, you've got to ask the question, we haven't even had the first leg of the V. Never mind a V-shaped recovery, what kind of downturn are we going to have in the months to come? If we have a downturn, and I think that remains the question at the moment.
And what kind of downturn is it? Is it a downturn in capital markets activity, or is it a downturn in a recessionary, classic recessionary type of way where credit losses do become the issue? Ken was talking about how credit losses are not going to be the issue. At the same time, JPMorgan, Jamie Dimon came out and said they want to be conservative. They increased their loan loss provisions because they want to get ahead of whatever could come. It is interesting to see the different approaches of the different banks trying to game that out and gird for the future.
So far, the numbers are solid, and we've seen that repeatedly across Wall Street. One more name still to come, just to wrap up earnings on Wall Street. You'll hear from Citi later on this morning. Those numbers come at about 8 a.m. Eastern time, so 1 hour and 5 minutes away. Up next on the programme, we'll catch up with Alessio de Longis of Invesco, Adam Hodge of Pulpit International, Luria of D.A. Davidson, and Priya Misra of JPMorgan Asset Management. Live from New York City with equity futures just about positive by 1/10%. The second hour of Bloomberg Surveillance is up next.
In terms of the hard data, it's going to soften.
What you're seeing is an economy that started from a solid baseline in wait-and-see mode, just like the Fed.
What's so unsettling right now, however, is the uncertainty of what we could see if these tariffs go through and the economy slows.
Consumers are really on their heels now. They're anticipating higher prices.
Right now, uncertainty is at an all-time high. We have volatility that is at an all-time high, and all of those factors are constraining economic activity.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and these are your scores. Equity futures on the S&P just about positive across the board on both the S&P 500 and on the Nasdaq 100. We've managed to string together 2 days of gains on the S&P. We haven't done that since April 2nd, Liberation Day. It has been a struggle in this equity market. If you ask the banks, it hasn't been much of a struggle at all. They've been very busy making money. Equity sales and trading revenue, it's a beat almost across the board at every single bank on Wall Street at the moment. In the pre-market at the moment, Bank of America is marginally higher by 1.8% in early trading. Bank of America this morning, revenue from equity trading rose 17%. Lisa, that's a record.
Yeah, at the same time that they also saw net interest income exceed expectations, basically in line, but a little bit higher. The interesting part about Bank of America is that they seem to be most leveraged to the consumer and to corporate health. They talk about a changing environment. That is maybe the euphemism that they use around tariffs, but they don't express concern, at least in the numbers and the projection forward, of a real deterioration in consumer experience. And that, to me, is really the ultimate question. How much of a forward look are these companies giving us with their earnings, not maybe the rhetoric?
Wrapping up earnings on Wall Street later on this morning, in about 60 minutes, we'll hear from Citigroup. Then later on after the closing bell, a company that has given you a forward look, United Airlines. This was the first industry to come out in the first quarter and say, Lisa, you know what? Things aren't going so well.
And it's not going so well on domestic travel. Very interesting to see whether international travel also taking a hit inbound from overseas to the United States. We are hearing anecdotally that a whole host of non-U.S. travelers are not coming here for vacation, particularly Canada. They are taking their business elsewhere. This is going to be a big question, though. How do they get ahead of this? Do they buy back their shares? Do they cut their flight routes so that they can increase prices or keep prices the same? How much of an offset do they get from lower energy prices? In other words, companies adapt and adjust. How do they plan on doing it?
There's a great line on Wall Street that you can stop panicking when officials start to. And I'm not saying the White House is panicking. I'm not saying that at all, because they're showing no real sign of that. But in their actions, they are concerned. The very fact that we have exemptions now for certain industries, the very fact that the president is now considering some kind of relief for autos. And at the same time, you have finally a Fed official that's willing to say, you know what, I would front load rate cuts if this economy started to roll over.
That's been enough to get stocks back to less than 5% below where they were on Liberation Day. That gives you a sense of how much we've retraced the volatile ups and downs that we've gotten during the whipsaws of policy over the past week. A real question here about how much support that actually is at a time where we haven't seen or projected the hit from possible consumer retrenchment. And that is something that is impossible to predict.
For now, at least, it's helping to stabilize the bond market. The 10-year at the moment yields just about unchanged, 4.38. Coming up this hour, we'll catch up with Alessio de Longis of Invesco as stocks look to build on a 2-day winning streak. We'll catch up with Adam Hodge of Pulpit International as President Trump considers more tariff relief, and Priya Misra of JPMorgan Asset Management as Treasury Secretary Scott Bessent downplays the recent sell-off. We begin this hour with stocks higher as the president considers temporary relief and temporary tariff exemptions for the U.S. auto sector. Joining us now to discuss, Alessio de Longis of Invesco. Alessio, it's good to see you, my friend. It's been too long. Let's take a giant step back. How have things been the last 4 months for you? How have things changed relative to how you started 25 compared to where we are now?
From a positioning perspective, we have entered the year in a defensive way, and I would say we were probably positioned defensive way too early. We went defensive towards the late summer of last year. Clearly, that didn't play out across most asset classes in Q4, and really we felt validated more recently. Our process is really data-driven, and we have been seeing this weakening in the economy, a very gradual weakening, below trend growth, decelerating growth expectations, very demanding valuations not being really met by the performance of the economy. And now we feel that the price action have validated that positioning. Where are we today? Well, now we are in a place where I think now that the dust settles from a headline perspective and the confusion that this is creating, the economy is going to start telling us the truth. I think now it's about, well, we focus less on X headlines or Truth Social headlines over the next 90 days, what is the impact on the economy? How much the private sector is going to begin to pull back while we still don't have clarity of whether the fiscal impulse is going to come and offset that. We have not certainty, but we have more clarity in Europe about the important, meaningful fiscal thrust that is going to come supporting that area of the world. But in the US, we're now in a situation where the private sector is likely going to pull back as a result of all of this. And the fiscal impulse is definitely not what we expected in November with the result of the election.
If that begins to show up in the hard data, do you think, given the correction we've seen in financial markets worldwide, do you think we have the capacity to absorb that bad news?
I think you alluded to it earlier, we have a Federal Reserve that for the right reasons is saying, if I weigh in the impact on inflation and I weigh in the impact on growth, we don't really have a compelling case to support here from a monetary standpoint. And this is not a monetary fix. This is a fiscal fix, right? Tariffs are a tax. The only way to offset it is through an equivalent injection of impulse, of fiscal impulse. And it's not clear to me, we know that fiscal works with a very, very long delay. I think that we have an issue with valuations. I think we have an issue with the catalyst and the justifications for those valuations, especially in the US. They were completely driven by non-tariff related stories. It was all about nearly monopolistic conditions that US big tech used to have. Now we're challenging that assumption. So I have a difficult time seeing where the genuine new positive catalysts are going to come from over the next few months. Now, this is not a panic mode. This is one of, I think, where putting risk on in the market is really more thoughtful. I think the next leg higher is going to be led by non-US equities and international assets, including a big portion of dollar declines over the next few months and years.
I want to pick up on that. Krishna Mueller-Glissmann of Goldman Sachs earlier laid it out as sort of three buckets of market action or market drivers right now. You've got policy uncertainty, you've got the structural cycle, and you've got the business cycle. You touched on the business cycle, the potential for watching that hard data. Policy uncertainty, a lot of people think that maybe we've seen peak volatility in headlines. That remains to be seen. The structural one, which you just referred to, how big of a driver is this shift away from U.S. dollar-denominated assets?
So by structural, let's put it into context. We're not talking about demographic type structurals, the productivity type structurals, so the 20, 30-year shock, but rather what is the next full length of a business cycle, the next 10-year cycle, right? And that is typically driven by these, you can see the data, this absolute highs and lows in dollar cycles, in relative equity performance between regions. I think the skew of probabilities is very clearly tilted towards a non-US cycle, non-US led cycle after this recession, whenever that one will come, or sooner. What is the evidence for that? Valuations are the biggest driver of that 10-year plus horizon. Then we need a catalyst. We mentioned the catalysts there are a few. We talked about the rotation from growth into value, meaning the rotation out of the thematic big tech. There is an element also of just dollar valuations and the requirement and the catalyst here coming from the new administration, regardless of whether we're going to have tariffs and how high they're going to be, regardless of how the negotiations go. But the byproduct of all of this is that this administration will not tolerate a deterioration in trade balances. So I'm not even talking about closing the trade balances, because that is simply not going to happen. The condition that satisfies all of these paths is one of lower dollar, right?
Well, so this is the reason why a lot of people are piling into this trade. Can you give me a sense of how much you have reduced your dollar exposure? Sort of where the dollar exposure has come from and where it is going in your recommended allocations from Invesco?
Only 3-4 months ago, we were a max dollar overweight. And steadily over the last 3-4 months, actually before this tariff event, we had neutralized the dollar positioning for the first time in several months. What the biggest catalyst for that change was we are beginning to see, it's a reflection of where expectations have been. We're seeing positive economic surprises outside of the U.S. We've been seeing those steadily over the last few months. Now, remember, this has nothing to do with how strong the rest of the world is, but it's all about relative to expectations. The expectations outside of the U.S. had beaten down so much that the bar for positive surprises has been very, very low, and they're now being met. The second has been this complete cyclical divergence in earnings revisions or earnings expectations. We have seen now, because of the fiscal impulse in Europe, earnings revisions really taking a leg higher outside of the US and a leg lower in the US. This cyclical divergence in earnings expectations and earnings revisions has been a big catalyst for that dollar unwind.
Can I ask you what kind of dollar we're going back to? Let's take euro dollar as a currency pair, for example. What kind of numbers do you think we're returning to?
So let's talk about economic metrics, the real economic metrics. When you look at purchasing power parity type of metrics, where relative inflation differentials, relative productivity differentials, the typical macro models are showing reasonable valuation levels for the euro at 125, 130. For the yen, similarly, 110 is still within economic fair values. And then currencies have a tendency to overshoot. So to answer your question succinctly, euro north of 130 over the next 3 to 5 years is really not a bold call in my mind.
So my trick question to ask graduates on trading floors, ask them where they think euro dollar was in the Eurozone financial crisis and the debt crisis between 2011 and 2012. And it was a band between 130 to 150. There was just this stubborn current account surplus driven by Germany that just drove this structural bid into the euro that eventually they had to fight in 2014 with negative rates. Are we going back to thinking about those kinds of themes, those kinds of systematic things, structural issues that drive the euro?
I would say so. Productivity differentials have not, despite what we talk about in terms of technology and U.S. exceptionalism, when you look at GDP per capita growth and you correct for the fact that in the U.S. we work a lot harder in terms of number of days, productivity differentials are not that different.
But Europe can't lose that access to the U.S. consumer. That would be the issue I have with that. That worked in 2011, 2012 without aggressive tariffs from this president. With aggressive tariffs, I just wonder how that shakes out this time around.
The issue with tariffs is that I am wholeheartedly convinced, based on research I've done my entire career, tariffs, if they're going to have an impact on the trade deficit, it has nothing to do with relative prices. It has everything to do with the shock that they will have on U.S. demand. What do I mean by that? The income elasticity, the propensity of U.S. consumers to consume is twice as large as the propensity to consume by European citizens. So what tariffs will do in adjusting the trade deficit is most likely to bring in a meaningful downshift adjustment in U.S. demand rather than impacting the relative pricing competitiveness between European products and U.S. products. In a nutshell, euro higher, most likely through the usual channels. Much easier monetary policy in the U.S.
Okay.
Wider interest rate differentials in favor of the Eurozone, which as of today, we simply cannot even conceive, right? But if we do have fiscal impulse in Europe and a more meaningful downshift adjustment in the U.S., yield differentials much closer to a strengthening euro.
Alessio, appreciate your time. Lots to think about. Alessio, the longest there of Invesco. Lisa, euro dollar at the moment, 113.36. I'm still trying to think about this, what it means for the ECB. There is another world that if they have to absorb all the other capacity out of China, where they have to actually cut rates aggressively in Europe too, in response to that.
If they have a strong economy, though, it could go the other way. The tail risks have just gotten a lot wider. And for Europe, it had always been a slow growth kind of paradigm. To Alessio's point, yields were always going to be lower than the U.S. Well, is that going to be the case anymore if that's where the growth ends up being driven from in some capacity? I'm not saying it is, so before I get hate mail, but that is sort of...
You got hate mail this morning.
I don't know. I imagine I'll say something like that and I'll say, are you kidding me? We're coming off such a low growth base and where is the tech investment?
No one knows anything.
You know, no one knows anything. That's
no
a good
one
way
knows
to say it. Thank you.
Euro-dollar, 113.36. I'm not sure anyone can insult you with any conviction whatsoever.
Oh, they still will.
You know.
It's fine. I welcome it.
Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Just a relook at Bank of America earnings. Those shares higher by 1.8% in the pre-market, beating estimates on total trading revenue and net interest income. With the Wall Street trading bonanza continuing, CEO Brian Moynihan expecting a, quote, changing economy in the future, but adding that consumers are maintaining healthy credit quality. Elsewhere in earnings, Johnson & Johnson beating expectations and maintaining its earnings outlook. Shares are lower by nearly 0.9%, weighing on the industry. The Trump administration's probe into drug imports as it plans tariffs. Johnson & Johnson CFO sees the investigation as beneficial, though, saying that it might show that most drugs imports are cheap generics. Elsewhere, Harvard University has rejected demands from the Trump administration to combat anti-Semitism, citing threats to its independence and constitutional rights. In response, the federal government will freeze $2.2 billion in multi-year grants to the university. And that's your brief, John.
Danny, thank you. How could anyone insult Bremo? We all want the answer to that. How could they?
Very, very easily. It's okay. I welcome it. But
Brutal.
I'm just saying there are other arguments. I'm recognizing them.
We're all open to other arguments. Up next on the programme, possible tariff relief for autos.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time.
Up next on the programme, Adam Hodge of Pulpit International, live from New York City this morning. Good morning. Equity futures just about positive by 0.1% on the S&P, on the Nasdaq 100 up by 0.15, on the Russell just about unchanged. And the surveillance this morning, possible tariff relief for autos.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here, but they need a little bit of time. So I'm talking about things like that.
So here's the latest this morning. President Trump exploring possible temporary exemptions for imported vehicles to give car makers time to set up U.S. manufacturing sites. Bloomberg's Tyler Kendall joins us now for more. So, Tyler, help us understand what they're considering here and how much time they'd be given.
Yeah, hey, John. So President Trump did not specify exactly what products could see the short-term exemption or what timeline he would implement it under, but he did indicate that he is considering a short-term exemption for car makers, particularly when it comes to those that are moving auto part production from Mexico and Canada to the U.S. As you know, there's already that 25% tariff in place for fully assembled autos, but as of now, we're still waiting for the auto part tariff to go into place. That's expected to happen by May 3rd. And part of this is because the U.S. has said that it will only tariff non-U.S. content within those auto parts. But it is starting to prove a little difficult to discern between what is non-U.S. content and U.S. content, considering that the supply chains across the borders are just so highly integrated. Now, we know that the big three autos in particular have been lobbying this White House. People familiar with the matter do tell Bloomberg News that these auto companies are prepared to accept a tariff on fully assembled vehicles as well as larger auto parts like engines or transmissions, but that they really are pushing for exemptions when it comes to those smaller auto parts. We'll have to see where these negotiations lead. As President Trump, you heard him there, sort of opening the door here to talk particularly with the private sector. And it comes, as you well know, John, that he's also opening the door to potentially other exemptions when it comes to other sector-specific tariffs we're expecting to see. He said the other day that he would be interested in looking potentially into exemptions on chip products as the administration formally launches its Section 232 investigations into chips and pharmaceuticals.
Tyler, appreciate it. Tyler Kendall down in Washington, D.C. Automakers rallying in the last 24 hours on both sides of the Atlantic, Lisa, not just the U.S., but also in Europe. Volkswagen up in today's trading.
They make a lot of parts in the U.S. and they make a lot of cars here. They actually export cars, BMW in particular. So you have to wonder exactly what we're trying to get at and who's getting penalized. All of a sudden, it's a big breath. Let's take some time.
Let's take a deep breath right now and have a conversation with Adam Hodge of Pulpit International. Adam, welcome to the programme, sir. The administration for a lot of people, have correctly identified the issue in the US economy. Where people disagree is the execution and approach of the last few weeks. What kind of approach would you like to see the White House take in the months to come?
John, look, I think you nail it right on the head. There's no question that for many of the challenges that we face in the global economy, Trump does diagnose the problem. The problem is the execution, the solution that he puts on the table, right? I mean, broad global reciprocal tariffs are not going to address the bigger challenges that we have in the global economy, from China's dumping and overcapacity of autos and steel and a bunch of other sectors around the economy. So they have diagnosed the problem. They haven't quite gotten to the solution. And the thing that I keep coming back to is the pullback on domestic investments, right? We, in the last few years in the Biden administration, made a bunch of investments in key sectors. So yes, semiconductors, steel and aluminum, try to do a deal with the Europeans on that. That was all to try to help reassure the domestic manufacturing capacity here in the U.S. with our partners coming along for the ride. Now you've stuck a fork in their eye, and I don't think they're going to be all that excited about doing deals or trying to find other ways to address some of the bigger fundamental problems that we have.
Adam, why have those investments not done more to reshore production in the U.S.?
I mean, I think there's one element that it just takes time to get money out the door. So, like, you have seen a coupling of both investments and tax incentives, and you did see a whole bunch of investments across the country in the last 4 years. SK Hynix, right, invested a huge battery facility in Georgia. A bunch of TSMC in Arizona, right? Those deals were announced, those investments were being made, and it does take time for those things to come into action. I think what you are looking for what companies and what we're hearing from our clients is just more certainty. They really want to get a sense of where are things headed and how do we adjust and address the challenges that we have from the Trump administration.
How much bipartisan support is there, Adam, for some level of tariffs to encourage or expedite the system of reshoring, given the fact that some of the tariffs put on under the first Trump administration remained under Biden?
The tariffs did remain, but I think you're getting to a larger point here, Lisa, right? Like, any of these sort of 90-day deals that we could expect from foreign countries are going to require Congress to pass legislation. Any adjustment to tariff rates and taking lower tariffs from other foreign countries requires an act of Congress. In this environment, I'm deeply skeptical that you're going to get 60 votes in the Senate and bipartisan majorities for huge tariff increases. Right? I mean, USMCA was unique in that there really was give and take from Democrats and Republicans. The Trump administration did engage Democrats on the Hill to try to get a deal that also had, just the labor and environmental issues. That was part of a framework. You poison the well. I think it's really hard to see any type of bipartisan agreement for a congressional action in the next several years.
Trade deals are tough. They're complex. Adam, appreciate your input. Adam Hodge there of Pulpit International. It's going to be a very busy negotiation period for this administration, but to make trade deals happen, it's very difficult. Ask the UK post-Brexit. It's very hard to make it happen.
Especially given the 90-day window. Then on top of that, months-long investigations, the different timetables of all of these different tariff regimes, these tariff buckets that we have, very hard to keep track of. If someone has a flow chart out there, please send it over of all of them and that is editable in Google Documents. I think that could be really helpful.
I'm attempting to make it very simple. Focus on one relationship, the US and China, and focus on a consistent message coming from the Treasury Secretary. He wants the Chinese economy to rebalance towards consumption and away from exports. The issue they've got right now is China's not negotiating. They're not coming to the table. We're not seeing that at all.
And we don't have a sense of where the leverage is right now, given the fact that China doesn't necessarily have to worry about the pain inflicted on its people in the same kind of way as, an electorate.
No elections. Equity futures right now in the S&P, positive by 0.1%. Up next, Luria of D.A. Davidson. The The opening bell's about 2 hours away. Equity futures on the S&P 500 doing okay, up by 0.1% on the S&P, up 0.2 on the Nasdaq 100 as we attempt to wrap up earnings season on Wall Street. Let's get you some movers with Danny Berger. Hey, Danny.
Hey, John. Another bank earning another record haul for equities trading, this time coming from Bank of America. Shares up 2.4% in the market trade. Not only was the equity trading strong, it also beat on net interest income, with the bank citing a consumer that is resilient and healthy, so its loan loss provisions also lower than expected. To the downside this morning, Boeing shares are falling in the pre-market trade, down more than 3%. A scoop from the Bloomberg team that China has told its airlines stop taking Boeing deliveries, a change in the trade tit for tat that focuses more on individual companies than overall levels. It also not just halting deliveries from Boeing's, but U.S. part suppliers, so companies like Howmet also falling in the pre-market trade. Wrapping things up with Netflix, this from a late-in-the-day Wall Street Journal story yesterday, shares up 2.33%, that Netflix has set itself some very, very lofty goals, maybe showing some confidence from the executives there, that by 2030 they want to double revenue and reach $1 trillion in market capitalization. They think they can do that. Again, it is a big ask considering market cap at the moment just below $400 billion, John.
Danny, thank you. The latest there on Netflix. Danny mentioned Bank of America. Let's talk about that. On our radar this morning, Bank of America beating estimates on total trading revenue and net interest income as Wall Street continues its trading bonanza. The CEO, Brian Moynihan, expecting a, quote, changing economy in the future, but Lisa adding that consumers are maintaining healthy credit quality.
Yeah, and in some of the further commentary that we're getting, they just double down on that. They haven't seen deterioration. It has continued to be strong, which raises the question of how much they are seeing or sensing out or not some of the deterioration in economic trajectory in the United States that a lot of people are expecting. Again, these banks were supposed to be conservative. JPMorgan set the tone by increasing their loan loss provisions. That's not what we're seeing from any of the others, and that's not really the rhetoric we're hearing either.
I can't predict the future. We won't pretend to. We don't have a crystal ball. But if you want to assess risk, if you're in the business of doing that, which most of you are, you've got to understand where we are and how resilient corporate America might be going into a downturn. And what the banks are telling you at the moment, the banks are telling you they're in pretty good condition and they might be able to weather a storm if there is one.
So why is there this dissonance? And this goes to the soft data, hard data debate, which will be a theme for the rest of this year, I expect. But you go to this question, why are people feeling like 2008? Why are people feeling like 2000? Why are people feeling like the last crisis, 2020? Those are all of the metrics of sentiment. Why are we getting those types of metrics? If you're looking in the data, they are still spending. Companies are still seeing plenty of activity and people paying their bills.
Do you think we'll have a different tone later on this afternoon when we get earnings from United Airlines?
Perhaps. I think that that's the expectation. That said, how much do companies have the ability to adjust and how much are people still flying, just maybe marginally less? Remember, Delta gave a pretty negative outlook, but it still was coming down from a very lofty level, and it wasn't going down to that kind of horrible level. It was just going down to something that was more reasonable rather than the revenge travel that everybody did when they were sick of being home in their
I have to admit, I'm pleased we're past that because that was brutal. Traveling wasn't nice.
Wait, what are you talking about?
Going to the airport was like going to war. Everyone was out for each other. It was brutal.
Gate lice?
You liked that?
Well, love
the tone
gate
in the
lice.
airport,
No,
travel, the
look,
way they
you're
treated
right.
you. The
Okay.
airlines were awful too.
I understand. People were crowded. They were desperate to get their revenge travel on. I think things have calmed down, so maybe you'll enjoy traveling again.
Sit on the plane, they'd bring some food and slam it down on the table.
Well, I don't know what airline you're traveling on, but my airline doesn't do that.
Another time. It wasn't my airline. It's another airline. It wasn't your airline either.
Okay.
And it's only one other airline, so figure it out. You know the answer to that.
Mohammed?
OK. Bank of America right now is positive by 2%. Certainly wasn't Bank of America. They treat you very well. Equity futures on the S&P positive by 0.1%. The president considering possible tariff exemptions on imported cars to give auto companies more time to set up US production. This is the White House initiates probes for pharmaceutical and chip tariffs. So given with one hand and maybe taken with the other this morning.
So it's the idea of trying to make a big statement on one hand and then try to reassess and put some time between here and there. How did these negotiations go? I know that Scott Bessent, the Treasury Secretary, is going to be meeting with the Japanese trade delegation in the near future. They're going to be the first. How do these conversations go when it's unclear what Treasury Secretary Bessent can say to President Trump, what is exactly the tariff rate currently, what the exemptions are, and what the ultimate goal is with specific trading partners? It's just, again, that flow chart. Please send it over because I'm having trouble. I'm struggling.
We loved the conversation with Annmarie yesterday. You can see exactly what he's trying to do. First come, first served. the best deal goes for the first person who comes to the table, which at the moment appears to be the Japanese delegation. But that's kind of like the carrot for everyone else. At the same time, there's this stick, which is some very high tariffs.
Does that mean that they haven't gotten that many offers? Does that mean that they're actually struggling to get them in? Look, I also wonder, are they trying to create a coalition now to try to come to China as a group rather than alone? It's sort of a retroactive action after the initial action. And again, please, the flowchart.
The NEC director, Kevin Hassett, says there's 10 great offers. I think it was what he said in the last 24 hours.
10 great offers. So let's hear them.
Watch this space. Watch this space. Watch this space too. Mark Zuckerberg taking a stand in the FTC's Meta antitrust case, testifying about the company's 2012 purchase of Instagram. Federal prosecutors looking to prove Meta brought its way to a social networking monopoly. Lisa, that stopped this morning, up by 2/10.
Mark Zuckerberg is going to say at the time we were very concerned that we were paying too much. We had no idea. This was very difficult, and that Meta was faced with a sea change in competitive conditions. On the flip side, the argument is going to be, look at what happened when there was the potential banning of TikTok. Look who got the benefit. It was really Instagram. It was Facebook. It was Meta. So it shows how singular they are in their market position.
There was a time when the president was deeply unhappy about that prospect as well. And now they've kind of made up, right?
Well, now Mark Zuckerberg says that he's badass and it's wonderful and he's wearing a necklace and things have changed.
There's a big change in the last 12 months. Let's talk about tech a little bit more. Apple, looking to recover recent losses from tariff uncertainty. The Trump administration moving forward with trade probes for semiconductors. Gil Luria of D.A. Davidson writing, Apple is more in a bind than other mega caps because it has not only to deal with the exposure to tariffs, but also to a slowing US consumer. Gil joins us now for more. Gil, welcome to the programme. Let's talk about these exemptions first. If these companies are focused on securing exemptions, who's focused on building factories domestically here in the United States?
Well, they all have to. They all have to align themselves with this administration. The administration's made it clear that it takes action if you don't. So for the companies that are in the business of hardware, of the mega caps, we're talking about Apple and Nvidia, they've had to make some pretty lofty statements about bringing production back to the U.S., and they're going to have to start acting on those. But they're also going to have to start taking more and more production out of China because the theme of decoupling seems to be almost beyond the theme of tariffs.
Well, Gil, as you know, Apple started that process. They started to shift production to places like India. Can production in India meet U.S. demand?
Not in the short term. Right now, they're scrambling to make phones in India. They tried to fly those out before the tariffs come in to save a little bit here and there. But they can't make all the iPhones outside of China right now. They can start ramping up that production over the next several years. But for the foreseeable future, they have to make phones in China. And ultimately, the phones in China will only be for domestic production. But that's a multi-year process to get from where we are now to where they're producing in countries that have zero tariffs or lower tariffs.
The shares are down almost 20% so far this year, and yet still pretty high valuation, still pricing in quite a bit of growth. Gil, do you think that investors are still too sanguine about the fact that the upgrade cycle and the next phase of the consumer spending cycle isn't going to look quite how they thought it was maybe 2 months ago?
Yeah, investors' expectations on those fronts have been reduced very substantially. I think there's very little contribution from AI embedded in expectations now. There's very little expectation that consumer will be strong. I think there's an understanding that this year is going to be a tough year for Apple because the consumer was already weakening before the tariffs. Then we layer Doge, we layer less immigration, we layer the concerns from tariff. So investors understand all that, but what they also know is that Apple is a product that we're going to continue to consume more and more of. Am I going to buy a new phone in the next 3 to 5 years? Am I going to pay more for it? Am I going to use more of Apple's services? If all those things are true, people see Apple as a defensive investment like Costco, like Walmart, not like a technology company. And that's why the multiple is persistently high.
Gil, let's talk about another technology company. This time it's NVIDIA. Just getting this post from the President of the United States out on social media. NVIDIA committing $500 billion to build AI supercomputers, plus in the United States exclusively. This is very big and exciting news. All necessary permits will be expedited and quickly delivered to NVIDIA, as they will to all companies committing to be part of the golden age of America. Gil, do we have the talent, the skills, the workers in America to make these kind of shifts and fast?
Not today, we don't, but we need that talent. This is very important. We need to bring those skills back to the U.S. Right now, they're almost entirely in Taiwan and China. And we have to learn how to make this technology because it's critical for our infrastructure. It's critical for our national security. And that's what NVIDIA and TSMC are now doing. They're moving production to the U.S. There already is some production in North America, but they're moving more of it now into the U.S. because there's been a decision that this is a matter of national security. Now, this isn't something NVIDIA would have chosen to do otherwise, but they have to make a gesture to President Trump and his administration because we're now in an investigation of semi-tariffs and policy where this administration is going to make important decisions about limiting sales to China. And if NVIDIA is selling somewhere between 20 and 40% of its equipment into Chinese companies and into China, it really cares about where those restrictions are going. So this is the time it needed to make a gesture towards President Trump in order to try to skirt the further restrictions in terms of the relationship with China.
On January 21st, Gil, we were talking about how this president seemed to really celebrate the national champions of the United States. People were saying that this was a pro-business president who wanted to see the giants that really represented this country, in particular tech, to really succeed. Then there were some real questions about that. Would the policies that he put in place with respect to tariffs undermine them completely, Apple leading the way? How much support are we getting a sense that this president will give to U.S. national champions as this process of some sort of transition is underway?
They're a party in the negotiation. This is why they need to make these gestures. They shouldn't take anything for granted here. They are negotiating with this administration just like all these other countries are negotiating with the administration. The administration has an agenda. That's what they're trying to pursue. If Apple, NVIDIA, and the other mega caps cooperate with the administration, they'll get the positive outcome. And if they don't, they won't. Let's not forget there's a long-term memory. We're talking today about the Meta trial. The Meta trial isn't about a monopoly. Meta isn't a monopoly. The Meta trial is about, it was about Cambridge Analytica. It was about deplatforming President Trump. There's a consistent, persistent notion across administrations that big tech is out of control and that needs to be reined in. And that's how they need to think about this, is how do they work with the administration without making the administration feel like they're out of control.
Hey, Gil, appreciate your input and your opinion. Thank you, sir. Gil Luria there of D.A. Davidson. Equity futures at the moment just about unchanged. Let's get you an update on news elsewhere. Lots going on. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A New Mexico man was charged in connection with arson attacks on a Tesla dealership in the state's Republican Party headquarters. 40-year-old Jamison Wagner faces 2 federal charges related to separate fires that involved homemade incendiary devices. Prosecutors described it as domestic terrorism. Wagner faces up to 20 years for each count if convicted. Apple will start analyzing customer data to improve its AI platform. It typically uses synthetic data to train its models, but that information isn't always representative of consumer data. The plan is meant to help the company's AI catch up with competitors like OpenAI and Alphabet. Rory McIlroy's nail-biting victory at the Masters tournament was a rating success. Viewership was 33% higher than last year, making it the most watched Masters since 2018. The tournament's final round drew an average of over 12 million viewers, according to CBS. That's up significantly from the first 2 rounds on ESPN that averaged under 4 million. And that's your brief, John.
Hey, Danny, thank you. Just fantastic for the game, that's for sure. Danny Berger there. More from Danny later on in the next hour. Up next on the programme, defending the bond market.
I don't think there's a dumping, and I think we saw in the tick data either today or Friday that actually foreign ownerships picked up.
So you don't think it's sovereigns, potentially it's hedge funds unwinding?
I have no evidence that it's sovereigns.
Just a brilliant exchange between the Treasury Secretary and Annmarie yesterday. We'll have reaction from Priya Misra of JPMorgan Asset Management in just a moment. From New York City, you're watching Bloomberg TV. Equity futures turning slightly lower. We're down 0.2%, coming off the back of a two-day winning streak on the S&P 500, down 0.1% on the Nasdaq 100. If you turn to Bank of America in the pre-market, so far so good for the financials on Wall Street. That stock is up by 1.6%. Upside surprise on trading revenue, upside surprise on net interest income. Wrapping up earnings on Wall Street in just a moment. We'll hear from Citigroup in about 12 minutes from now. Under surveillance this morning, defending the bond market.
Even the president recently remarked that the bond market was, quote, queasy. Do you have a sense of who is dumping U.S. assets? Who's been dumping U.S. treasuries?
I don't think there's a dumping, and I think we saw in the tick data either today or Friday that actually foreign ownerships picked up. I think a lot of people got very leveraged, maybe out over their skis.
So you don't think it's sovereigns, potentially it's hedge funds unwinding?
I have no evidence that it's sovereigns.
So here's the latest this morning. The Treasury Secretary Scott Bessent downplaying the recent sell-off in the bond market while saying his department has the tools to address any dislocation if necessary. Priya Misra of JPMorgan Asset Management joins us now for more. Priya, good morning.
Morning.
You followed that exchange. What did you make of the explanation coming from the Treasury Secretary?
I think the Treasury Secretary is doing what a Treasury Secretary should do, be a cheerleader for the Treasury market. But, I do think he made very valid points that now, what we saw last week, the last few weeks, massive VAR shock. You're seeing 3 sigma, 6 sigma moves across assets. You're seeing correlations break down. Remember that equity-dollar correlation? That broke down. And so I think investors had to de-lever, de-risk, were there margin calls? So I think there was a lot of technical factors that drove that Treasury sell-off. In the background, though, there is this concern. There's $8 trillion of treasuries held by the rest of the world. Is the end game zero trade deficits? I don't think that's the end game, but concern around foreign demand for treasuries, maybe selling, I think that played into that fear, certainly played into the market, as well as if we're going to get $5 trillion more deficits because of what the House and the Senate are talking about. I think that it became this perfect storm. But I would take a step back and look at fundamentals. Ultimately, the Treasury market is driven by fundamentals. Fundamentals of the hard data has been strong, but we've just had this massive shock to the economy. I think the soft data is telling you that the hard data is likely to weaken. So I do think Treasuries are a good buy. Are we at peak? Hard to say, but we're getting there.
Well, you're getting to the ultimate test. What would happen if the data weakened? Would we buy Treasuries or not? Would the rest of the world allocate capital to the United States, which is important? What concerned people last week wasn't just a sell-off in treasuries. It was what was happening elsewhere in other asset classes. Now, we've seen moments like this one before, where you see forced selling of treasuries, big unwinds of trades, companies, hedge funds in trouble. That's not unique. What was interesting was the persistent dollar weakness alongside that, reinforcing the notion that maybe it was something else. Perhaps it's not, but that's what unnerved people in the past week. How would you reconcile what was going on there?
So I would say that the dollar, has been a highly owned asset, right, for the last few years. Now, I think there's structural components to that, U.S. exceptionalism. Look at where growth is. It is U.S. Companies, profit margins are high. And I think right after the election, there was this idea of re-acceleration. So the dollar got some more of a boost there. Plus, it was supposed to hedge equity risk. It was supposed to hedge risk assets, which is... So I think the dollar, the structural value in the dollar might still be there. Maybe we overdid it. In our view, the dollar still looks overvalued. So I think that's correcting. And then you had this treasury market that was overwhelmed, I think, with all of the selling. There were a lot of supposedly uncorrelated trades. Swap spreads is a supplementary leverage ratio trade. German Bund Treasury or that spread was supposed to be about German fiscal stimulus. You had an unwind, whether people got a tap on the shoulder, whether they're just trying to de-risk, whether it's margin calls. I think that overwhelmed. So you did have these two forces coming together, but it's unnerving when you see correlations break, when you see this EM market-like market moves. I think that's what reduced conviction levels. And we're seeing headlines every day. So I think uncertainty is high, not just for the economy, but for investors. And I think that's why you didn't see all this buying from domestic investors who might be concerned about the economy.
How much comfort do you get from the potential response function, not just from the Federal Reserve, but also the Treasury Department, with Treasury Secretary Scott Bessent saying that they could buy back off-the-run treasuries?
So I think from market functioning point of view, I think that buyback operation is useful. The Treasury launched it because the dealer balance sheet has been constrained as the Treasury market's grown. Can they help market dysfunction? Yes. Can they help? They still have to issue a lot of debt. So I think we're going to be watching beyond all the tariff news. We're going to be watching what's happening on the tax front. You know, are we going to get those spending cuts that were sort of promised by Speaker Johnson? If you don't get those spending cuts, the market has to then grapple with a lot more deficit. And maybe that end point of how low rates can go in a recession or in a slowdown is going to be higher because we've got all this fiscal stimulus. I'm a little bit more comforted by the Fed response function. And I think Governor Waller yesterday was crystal clear. Two scenarios, I mean, as clear as he can be, given that there's a lot of uncertainty, but just telling us how are they thinking about tariffs. And he talked about good news cuts and bad news cuts, showing you that asymmetry.
Okay, but here's the issue, and this is something that I haven't heard anybody address. If they were to cut rates in response to potential weakness that hasn't shown up enough yet in the data, wouldn't the long end just yield surge, price drop?
And you could argue maybe some of that happened last year when the Fed cut rates from 5.5, you had that long end selling off. But I would say, look at what was happening to hard data at that point. It was actually looking okay. Remember, we were concerned. August, September, we were concerned about the labor market. It stabilized, and that's why the long end sold off. I think, to your point, yes, the Fed has to be concerned. Will they let inflation expectations, those tips break-evens that have been declining, does that reverse? Which is why they can't be preemptive. I think that's what they're telling us. They're trying to explain their reaction function so that first really bad hard data, and maybe it's the labor market, I don't know, maybe it's hiring, maybe it's retail sales. We're going to be looking, not so much as there's this front loading of demand, we're going to be looking at discretionary spending. If I am going out to buy more because I think prices are going to go up, do I cut back on other things? So we're trying to understand how the consumer is responding, how are corporates responding? Are they just not hiring, or are they actually trying to protect margins and laying off? As that data worsens, I think then the Fed response doesn't unanchor inflation expectations. It actually helps stabilize it because those inflation expectations will crater when the data weakens. And then the Fed can say, no, we got your back. But I think you have to first see it in the data.
This is the communication dilemma of the Federal Reserve. Fed Chair Jay Powell can't go around talking like Governor Waller can. First and foremost, you have to pledge to anchor inflation expectations, to Priya's point. Then if you get the hit to growth and inflation expectations roll over, you can lean into the idea you're going to cut interest rates. They can shape the events they anticipate. And that's the big issue for them. You put out an outlook and it can influence inflation expectations even of themselves. To your point, if Chairman Powell comes out and starts speaking like Governor Waller, what do you think is going to happen? Yeah. Some people would argue exactly what you think is going to happen. Maybe inflation expectations start to creep higher because we start to have arguments around this table. Oh, they don't care about inflation expectations. That's the dilemma they're in.
And this is the reason why markets don't believe that they won't step in when there is a problem in the data. And that's the reason why you have the likes of Andrew Hollenhorst over at Citigroup reaffirming his belief in 125 basis points of rate cuts this year.
I'll leave Priya out of this debate because you won't want to wade in. But this is the advantage you have being a governor and not the Fed chair. The governor can create some distance between himself and the rest of the committee if, say, he wanted to become the next Fed chair.
Potentially.
In the next year or so.
So, do we trust that or do we trust Fed Chair Powell? This is the dilemma.
Priya, it's good to see you. I'm sure you're welcome being left out of that. Priya Misra, JPMorgan, thank you. Up next, Chris Marinac of Janney Montgomery Scott will catch up with Brent Schutte of Northwestern Mutual, and we'll speak to the Virginia Governor, Glenn Youngkin. All of that in the third hour of Bloomberg Surveillance. Up next.
I did not like all the mixed messaging we got on tariffs over the weekend.
We are getting some certainty. I just think markets haven't been liking the certainty that we're getting.
The more that Donald Trump seems to double down, the more investors think this is an unsustainable path forward.
It's not a sustainable situation.
If we continue along this current path of uncertainty, where objectives are not stated, it's going to continue to maintain, I think, an unhealthy level of volatility for the markets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Wrapping up earnings on Wall Street, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures slightly softer, down by 1/3% on the S&P. Following a two-day winning streak on the Nasdaq 100, down by 0.2%. If you turn to Bank of America, those numbers came out about an hour ago. Upside surprise on trading, on net interest income. That name is up by 1.8%. The takeaway from the bank, this consumer is in good shape. And this economy, for the first quarter at least, is doing okay. Similarly from Citi just moments ago, Lisa, those numbers crossing. Nothing to see here. Everything seems to be okay.
And it seems like the big question that we had two big questions. How much were they going to be preparing for some sort of downturn in consumer appetite? And how much was the wave of mergers and acquisitions deferred versus delayed? It seems like those are delayed, to start with that first, rather than deferred. And it seems like the consumer isn't weakening. The rhetoric from the Bank of America call is that, frankly, the consumer in the U.S. is in good shape. The investment banking pipeline is stronger than last quarter, and this from the CFO. Clients continue to show encouraging signs. This is a cycle that right now at least seems to be delayed, but not completely derailed.
So Bank of America doing absolutely fine. Goldman Sachs with a buyback of up to $40 billion. JPMorgan raising their outlook. Citi just crossed, Lisa. Full year 2025 guidance unchanged.
And the fact is, they actually saw better than expected banking business. Frankly, you're looking at all across the board beats and seeing that continuing. They also did beat on fixed income sales and trading. So the trading side of things even was good for them on the debt trading issue. Look, this comes to this question of how much is this a signal for the rest of corporate America versus a ballast in a storm with a lot of different pistons that are firing at different speeds. Right now, I'm not seeing weakness on any of those pistons.
The Citi up in a pre-market by 0.6%. To break down the numbers, let's bring in Shanali Bassett for more. Morning, Shanali.
Good morning, John. Listen, if the banks can do it, so can you. You have Citigroup keeping its targets for the full year. You had Bank of America do the same. The big question coming into this earnings season was, how do these companies set guidance? And so many other parts of corporate America looking to either scrap, cut, or not give a lot of clarity on theirs. For Citigroup, another promising sign, a key measure of their profitability, of course, their return on tangible common equity rose to 9.1%. This is significant for Jane Fraser, that is looking to get to 10 to 11% into 2026. This is a bank still in the middle of a big turnaround story. To Lisa's point earlier, very healthy on those core Wall Street businesses. Remember, Jane Fraser has been hiring, has been changing the composition of the top ranks in all of those businesses, and that's why that matters just so much. When it comes to net interest income, you're also looking at a little bit of a beat there, and you're also looking at credit quality remain quite healthy. So banks staying sanguine in the middle of all of this uncertainty.
Shanali, appreciate it. A release full of upside surprises, and I would say a more pointed address, more pointed commentary coming from Jane Fraser than maybe the rest of the street, Lisa, on some very important issues.
Yeah, she came out and she said, when all is said and done, the U.S. is still going to be the leading economy, and the U.S. dollar will still remain the reserve currency. So weighing in on some big topical issues of the day.
Citigroup in a pre-market up by about 0.5%. Joining us now to extend the conversation, Chris Marinac of Janney Montgomery Scott. Chris, welcome back to the programme, sir. Wall Street, that wraps it up. Earnings season. What's the big takeaway for you and the team?
Well, I think that the companies are very resilient, John. I think that the cost of funds has come down. Credit quality is stable, as you have all mentioned. We saw a slight reserve build at Citi, which has been true at the other banks so far. I think it is the calm before the storm, because we still have some uncertainty in the second and third quarter about how corporate America is going to act on recent events. Perhaps it is a non-event. We don't know yet. I'm looking for credit lines to be partially drawn and some of the C&I loan growth to get better in the second quarter, kind of like we saw in the first part of COVID in 2020. But this is not the same, obviously. These companies are in a very good position here with the credit quality and the loss expectations still being very muted. And I think we're a long way to go before we really call this a big credit event in terms of what's transpired in April.
Chris, is it encouraging or a bit cautionary that you're seeing a number of these banks not build credit loan loss provisions as much as some people had expected?
I think it is what we expected. I think the timing of when you rebuild reserves is going to be second and third quarter. If we see this inflection in the economy, if we do see a demand shock, as folks are worried about, if we do see lines of credit get drawn, we haven't really seen that yet. I think it might be starting to happen in the Fed data every Friday, but it's so early that it's hard to detect. I think at the end of the day, a lot is going to change day to day and week to week, that we may have a much more calmer attitude towards this fear here in a few more weeks.
The other question that we had was, is this mergers and acquisitions wave derailed, or is it just delayed? It seems like a lot of the banks that have come out say that it's just delayed. You've heard that from Morgan Stanley. You heard that from Bank of America. The pipeline is building. What do you think will catalyze those deals at a time where there still is quite a bit of uncertainty, Chris?
Well, Lisa, for the banks, I think regulatory reform is still here. I think we're still going to see rule changes and new staff members at the FDIC, the OCC, and even the Fed in terms of supervision. That's going to be a catalyst. I think the attitudes will change. Consolidation in these industries, whether it's banking or other sectors, is going to continue to happen. So I don't think we lose that. It's simply a delay. It's a pause. As stocks get stronger and we see some sort of stabilization of all of the noise and kerfluffle, that I think is going to back into more activity in the second and third quarter. So I haven't given up hope on that. I think the regulatory reform is the biggest component that we didn't see in prior years.
Hey, Chris, appreciate you jumping on. I know it's a busy morning for you. Chris Marinac there of Janney, Montgomery Scott, the latest on Citi. Lisa, we have heard that repeatedly in the last few days. Delayed, not derailed.
Right now, you're seeing a pipeline that is stronger than last quarter. This, according to the CFO of Bank of America. Over at Citigroup, they actually beat on their banking revenue, even at a time where deals were slow. So it raises the question, what are companies waiting for to take action, to pull the trigger, given the fact that the dust hasn't cleared entirely, but maybe we're past peak uncertainty.
Joining us now is Brent Schutte of Northwestern Mutual. Brent, welcome to the programme. Let's use that phrase that Chris Marinac just used, the calm before the storm. Looking at the earnings on Wall Street, calm. What about the storm, Brent? How big's that storm going to be?
I think that's an open question, but I think the delayed commentary ties more to this being, at least in many investors' minds, a negotiation. I believe it's something a little bit more than that. I believe it's revenue and restructuring. So on the trade side, I don't expect that to go away. And that's where I think you have uncertainty that's going to hang over the markets and the economy for the next 30, 60, 90 days, maybe even longer, as we go back and forth in the trade and tariff narrative. And that's where I think negotiations are going to be more difficult. And that's where I think perhaps Wall Street still has some surprises ahead, which may be more to the downside, not upside.
Speaking of Citigroup, the research team, just going to The Economist, Andrew Hoddenhorst saying the tariff pause may not pause the economic slowdown. Brent, I think this is important. People are pointing out that we were slowing down coming into 2025. What people were hopeful for was a pro-risk, pro-growth approach from the incoming administration to help growth accelerate through the year ahead. Brent, now people have got doubts, and clearly those doubts are captured by the soft data. And what we keep going back to repeatedly is whether that will be captured by the hard data in the weeks to come. What's your base case now?
I think it will be captured by the hard data. I think the fall in the market obviously brings back the wealth effect just a bit. And so you mentioned overall economic growth last year. Yes, it was positive, but it was heavily bifurcated. You think about manufacturing, you think about small cap companies not doing as well and small cap earnings being pulled back. You think about low end and middle end consumers being harmed already by interest rates that had risen to 21, 22% on credit card debt, auto loan debt. And that's where I think there was much bifurcation underneath the surface. And I think the question is, as you mentioned, can the high-end consumer continue to hold it up? I think the fall in the market will pull back some of that spending. I also think about a labor market, which overall was still looking strong, but there was bifurcation there. And I think Chair Powell characterized it as low hiring but low firing. Do companies continue to hold on to employees with the hope that things will be better in the future? I think that's the question going forward. And at least in the near term, I think the risks are still elevated, even though, quote unquote, uncertainty has come back. I still think there's plenty of uncertainty to go around for the next 90 days.
Brent, based on what you just said and the caution that you feel, are you selling rallies in equities? Certainly, we might get a third day of rally today, both in the S&P and the NASDAQ, going back to April 2nd, and go into bonds, or is the playbook changing?
I don't think the playbook has changed. Look, I think longer term bonds in the U.S. will be a little bit more challenged just because I do think inflation is still the likely outcome, given our deficit to GDP and the reality that I don't think sometimes we want to take our medicine. And that's where I think inflation is more likely an outcome. I understand the fears around the Treasury market. I do think that the dollar is going to pull back. It'll still be the global reserve currency, but might it not fall just a bit to help with some of the trade deficits that the administration sees as a problem? I think in the near term, if you were to move towards a recessionary environment, I think the dollar would, or the Treasury market would still find a ballast, and I think investors would still run there. I just think over longer periods of time, you are seeing more of a trend change, perhaps just a little bit away from the dollar and more towards other currencies and other asset classes.
Brett, there's another risk as well, which is that we're underestimating the strength of the U.S. economy. We're underestimating the other pillars of this administration's policies of deregulation, as well as some of the tax cuts to come. And that actually the U.S. consumer is fairly strong, and that we could bounce back from this bout of uncertainty with the same kind of momentum that we saw earlier this year. How do you sort of justify caution at a time where you're certainly seeing the deterioration in the soft data, but you're hearing rhetoric from companies portraying a very different reality?
Yeah, I mean, there's so many different ways to answer this question. I think the market still reflects the reality that no one believes that it's going to be anything more than just what you mentioned. I mean, trading at 20.5 times forward 12-month earnings expected to grow 10% in the S&P 500, I think already discounts some of that reality. I think if your narrative proves to be true, which we think about being more long-term investors, I think that's where you still, despite sounding like a broken record, you still want to own small and mid-cap companies trading at 13 to 14 times forward earnings that haven't grown that much in the past couple of years. In fact, for small caps, they've actually faltered. That's where I think it's not a necessarily sell everything type of an environment by any means. We stick to our long-term allocation, but maybe just nudge more towards those and even think about international securities, which I think will have a falling dollar as a tailwind for U.S.-based investors. And so I think the narrative going forward changes. People are still stuck in this last 5, 6, 7 years where U.S. large cap stocks have done well. I think you are now seeing the trend shifting, and I think there is an economic backdrop that supports that pushing forward, given what the U.S. is trying to accomplish with defense and trade.
Brent, this is such a strange moment. You brought up the reserve currency. How unusual is it to hear the CEO from a major financial institution feel the need to say that the dollar will remain the reserve currency?
It's a bit odd, but I think we've been here before. I mean, I always go back to the late 1990s, and having done this for almost 31 years now, I certainly remember the dollar being expensive back then. I remember U.S. exceptionalism. I remember U.S. assets trading at a premium. And then I remember the next 6 or 7 years, the dollar falling on the dollar index, I believe, from 120 down into the 70s. And it remained the reserve currency. This is just where I think there's a little bit of a restructuring going forward. And I think if the administration wants more trade, wants the U.S. to be more competitive, I think the dollar has to fall for that to occur. And that's where I think there's just a bit of a difference going forward, where you might see other asset classes do better as a result of that.
Well, Brent, other asset classes in other places, is that what you're anticipating?
I do. I think there's a different narrative that the international markets are waking up to, where they have to spend. You think about Europe and what happened in Europe. I think that's where there's a potential for those asset classes, which have been cheap. I think this is their moment where that cheapness may be met by a new reality, a catalyst that actually propels them forward. And they've done very well at the beginning of this year. And I expect them to continue to do fairly well in the coming years as the new narrative plays out.
Hey, Brent, appreciate the update. Brent Schutte there of Northwestern Mutual on the situation in financial markets. Let's start with that before we get to the banks. It's very different to say that there's been this very long dollar trade building up over the last 10 years because of exceptional US companies. That's one thing. To say that we're moving away from dollar-denominated assets like treasuries because you're doubting the policy stability of the US administration and the safe haven status of America, I think they're two very different stories.
This is the reason why markets tend to overshoot, because they take a narrative and then they push it to its illogical extreme, which is the loss of the U.S. dollar as a haven currency and treasuries that aren't going to get a bid from foreign investors. And then investors have to decide what is the right story. There is a very logical story that Brent just told there, that if the United States wants to increase its domestic industrial production and its exports and actually close that trade deficit, the dollar has to be weaker, period, full stop. And actually, one thing that Scott Bessent, in his prior job as Key Square Capital Management CEO, talked about this, that actually the dollar needed to be weaker to bring production back here, and then it could strengthen with a strong dollar policy.
Annmarie asked him a fantastic conversation, a fantastic question yesterday. When he was with us around the table, he talked about putting his ear to the door to listen to what policymakers were doing to understand how it might influence financial markets. And Annmarie asked him, what would your advice to be to other people who have to do that now, listening to you? And he said, focus on the fuller policy platform. That was basically the message. Don't focus just on trade, focus on all the other things as well. That's a really difficult thing to do at the moment because the volatility around policy, trade policy, is so high that it's difficult to imagine what's going to come next and where policy will be 12 months out.
The three-legged stool of policy with respect to tariffs, with respect to tax cuts, and with respect to deregulation. The other reason why it's difficult to game out is because it's unclear what they're going to coalesce around in terms of both tax cuts as well as deregulation in Washington, D.C. It is a murky picture.
Futures right now, just a little bit negative. We're down by 0.2%. It's been a very murky, difficult week or so. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Citi continuing the big trading quarter for the big banks this earnings season, up just under 1% in the pre-market trade. Citi reporting a beat on sales and trading revenue at $4.48 billion versus the $4.37 billion estimate. Loan loss provisions, though, did come in higher than estimated, but altogether, the results pushed Citi closer to its profitability targets. The Trump administration announced that it launched probes into semiconductor and pharma imports earlier this month, a move which could lead to new tariffs on the sectors. The probe, led by the Commerce Department, is investigating the impact of the imports on U.S. national security. President Donald Trump pledging to expedite permits for NVIDIA following the company's commitment to producing AI infrastructure in the U.S. In a post on Truth Social, Trump also promised expedited permitting for, quote, all companies committing to be part of the golden age of America. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Up next on the programme, the morning calls plus Tom Fitzgerald of TD Cowen with United Airlines reporting later on this afternoon. Live from New York City with futures slightly softer. We're down about 1/3%. This is Bloomberg. Two days of gains on the S&P 500, running into just a little bit of weakness this morning. We're down by 0.3% on the S&P, down 2 on the Nasdaq 100. That's the price action. Let's get you some morning calls. First up, Barclays downgrading General Motors to equal weight, expecting auto tariffs to continue to weigh on the stock. That name is down by 1% this morning. Your second call from Bank of America, double downgrading Dow to underperform, citing a perfect storm of softening macro, emerging trade barriers and rising costs. That name is down by almost 4%. And finally, Redburn Atlantic naming NVIDIA as a top pick, expecting resilience amid tariff uncertainty. That stock is just about unchanged in the pre-market. Let's turn to the airlines. United Airlines reporting after the closing bell. Tom Fitzgerald of TD Cowen writing, we expect a world of slower growth, higher inflation and a more isolationist United States to significantly disrupt the competitive environment for airlines. But United remains our best idea for 2025. Tom joins us now for more. Tom, welcome to the programme. We'll get to the best idea in just a moment. What would you expect in terms of guidance from the airlines, given what they've already told us over the past few weeks?
Thanks, Jonathan. Yeah, in United's case, I think it's going to be a little bit similar to Delta, where, maybe the second quarter has a possibility of being a little stronger than people expect, and we have strong international bookings out into the third quarter. I think the rest of the sector, it's going to be a lot more difficult. They're more exposed to price-sensitive leisure. They're also more exposed to customers who are booking much later on in the curve, more closer in, which makes it a lot more challenging to navigate an environment like this.
Tom, can we stay on international? Because we've all seen the same reports of inbound travel into the United States being absolutely dreadful. Bookings from places like Canada, from Europe, just not being great. What's happening on that front?
It's been a major headwind, and non-U.S. travel into the United States had already been depressed versus its 2019 levels. So this is just another headwind on that source of demand. For the U.S. airlines, Delta talked about last week how non-U.S. is only about 20% of their international point of sale mix. So it's less of an issue for them than it is for the European airlines or in Air Canada on their transporter market. But it's just another drag on top of weak government travel, weak travel in corporates like autos and agriculture, aerospace and defense, weak domestic economy cabin demand.
How much are United and Delta and American Airlines going to try to really capitalize on this moment and gain market share in a pretty significant way from the others, given the fact that they have other streams of revenue, credit cards, as well as significant loyalty programs, as well as catering to wealthier individuals that do typically spend more and offer them more profits?
Exactly. And I think that's what we think is going to happen. And they're going to use basic economy as a loss leader and use that really effectively to maintain share and put more pressure on the low-cost carriers who have already had a tough go of it post-COVID.
So that's the reason why maybe they stand out as being the brighter in the bunch in terms of airlines. I'm curious how much visibility you think they have going forward, whether they're going to offer a relatively sanguine look or whether they'll already have a sense of a deterioration in consumer demand that we see reflected in some of these surveys that are pretty dismal.
I think they're seeing it, and they're probably one of the first industries that's seen the pullback and seen this effect on uncertainty in the economy. Typically their crystal balls only go out 2 to 3 months where they can have real good conviction, and a lot of the rest of it is just finger in the wind. And people book international travel, that tends to be, you might book that several months in advance, but flying to Florida or Vegas, those tend to be a lot more closer in. So it's really challenging. It's already a hard industry to operate in the best of times. You're juggling a lot of plates, and this environment just makes it that much more harder.
Tom, when we first heard from Delta and they came out with that warning, they offered a whole range of excuses for it. It wasn't trade at the time. Really, the focus was on things like Doge and what would happen to confidence around business spending, contractors, federal workers, etc. Then there were the aviation safety issues as well. Can you pin down what was really weighing on that outlook, what led to that stalling in activity in the first quarter?
The Doge stuff was definitely real, probably less of an impact for Delta than United and American, just considering that they both hub in the D.C. area. But government travel is, several points of revenue, and the government adjacent, your Booz Allens of the world, that's another couple points of revenue. So that's pretty material if that's down 50%. I think the accident and some of the weather stuff, that wasn't as big of a headwind on the, that wasn't leading to the profit warning that we saw in March from the group. So I would say it was the Doge tariffs on government travel, which is just a segment of the corporate travel really. And then you get all the uncertainty around tariffs and the broader economy.
Tom, it doesn't sound great. When you say United's your top pick, do you mean a top pick in a down market, or do you actually think that stock can perform this year?
I think over the longer term, I think it really has I think they have the most upside of the U.S. airlines, and their current management team has them on an incredibly compelling trajectory. I think in a down market, if we're going into a deep recession, any type of consumer cyclical like this it's going to be tough, and then it's more on a relative basis on the short term.
It's certainly been difficult, that's for sure. Tom, appreciate your time. Tom Fitzgerald there of TD Cowen. Thank you, sir. Thank you very much. United Airlines down about 0.5%. Lisa, as you know, those numbers drop after the closing bell.
There are two different arguments here, and you distilled them well, which is this can be the brightest bulb in another kind of dull sea of bulbs, or this can be a real outperformer. Unclear to see. One thing that has been a theme is that the strongest players are going to consolidate market share during this period of time because they have the biggest ability to renegotiate supply chains and potentially to compete in price or invest in price, as Walmart said, and potentially attract new customers as a result.
You heard what he said about Doge. Doge is real. It really started to weigh on activity for businesses, contractors, federal workers. We saw that. That's what we heard from Delta pretty much directly.
It wasn't just the number of people who are federal workers who got laid off. Evidently, for every one person who works for the federal government, there are two contractors who do get revenues as a result. You have to think that some of these surveys that show that people increasingly are worried about losing their jobs have to do with the fact that people know people who have lost their jobs as a result of some of these efforts.
We'll have this conversation in just a moment. Futures are a little bit softer. No drama here. We're down by 0.4% on the S&P. Up next on the programme, the perfect guest to talk about some of these issues. We'll catch up with the Virginia Governor, Glenn Youngkin, as President Trump's tariffs hit at the state level. From New York, this is Bloomberg. Live from New York City, 60 minutes out from the opening bell. Equity futures at the moment negative here by 0.4% on the S&P. Coming into Tuesday, two-day winning streak on the S&P 500 for the first time since April 2nd. We're a little bit softer on the Nasdaq. We're down by 0.4% on the Russell as well. We're down by 0.7. Some economic data about across the Bloomberg terminal. This will become more and more important as the weeks and months progress with that data. Let's cross over to Bloomberg's Mike McKee. Good morning, Mike.
Good morning, John. You're right. We have a lot of new favorite indexes, including trade, and now the import price index. We also get export prices as well. Import prices fell on the month by 0.1%. Ex-petroleum, though, they're flat. The import price index on a year-over-year basis is up 0.9%. Exports were flat as well in terms of prices, but it's more about what the individual type of prices are that people are going to be concerned about. And what we saw last month was a rise in industrial supplies in terms of the amount of imports we got. And this time, import prices for industrial supplies, excluding petroleum, fell 0.2 after a 1.5% rise on the month. Now, one of the categories that rose a lot last month was metal imports, unfinished metal and finished goods related to metal because of the tariffs on aluminum and steel. Those were up 1.4% and 1.3%. So we are seeing some tariff effects there. The other number out this morning, Empire Manufacturing in New York, negative 8.1. That's better than we had last month, negative 20, but it still shows contraction in New York. New orders and shipments were down. A number of employees were down. Average work week was down. Unfortunately, both of the price indexes, prices paid and prices received, rose, and they are now at their highest in more than 2 years.
Mike, thank you, sir. We need to see that improve. Equity futures off the back of that, negative by about 1/3 on the S&P 500. In the bond market, yields lower at the front end of the curve. We're down by about 2 basis points to 3.82 on 10s at the moment, just about unchanged at 4.37. Let's keep it on trade. President Trump's tariff policy set to impact leadership at the state level. The Commonwealth of Virginia exporting nearly $22 billion worth of goods abroad last year, placing it in the top half of states and accounting for tens of thousands of jobs, according to US government data. Joining us now, the Republican governor of Virginia, Glenn Youngkin. Governor Youngkin, good to see you, sir.
Great to be with you. Thanks for having me. It's super to be back in studio with you, so I just appreciate you making time for me.
Well, thanks for dropping by. Let's talk about how exposed you might be to this tariff push. You've got some very large aerospace and defense companies in the state. How are you helping those companies and individuals that might be affected by some of this in the meantime?
Jonathan, I think we have to step back first and put the current moment in the tariff evolution in context. From while he was running all the way up until today, President Trump has been really consistent on the elements of his economic plan. First, he's going to use tariffs to reset trade balances. And decades of bad deals, he's talked about it. You've heard these words out of his mouth over and over again. Second of all, he's going to make sure that manufacturing is reshored and that we reinflate or reinvigorate the hollowed out middle class. Third, we're going to reestablish fiscal responsibility in Washington. Fourth, we're going to reestablish energy dominance. And finally, through deregulation, we're going to make it even better to do business in America. And those elements are all in motion at the same time. The trade moment for us and the tariff moment for us is also this 90-day pause, which is giving the opportunity for deals. And every cabinet member has repeated there's 75 countries in motion right now. And I would expect that there will be some significant trade deals struck. I do think that there will be a level of ongoing tariffs. And the 10% number wasn't one picked out of a hat, and they call that the base tariff. But I'm a governor watching, but I do expect that there will be deals cut, and those deals, importantly, will be with some of our largest trading partners, India and Japan and Korea. And so this is what's going to happen over the next many months. And most importantly, I think that will bring some confidence to the market that this reset, which has to happen, and disruption is part of a reset, will open up long-term opportunity. Now, Virginia, we're seeing that long-term opportunity every day, and that's through our economic development pipeline. We've had an incredibly robust 3 years. We've had record investment or commitments from businesses expanding in Virginia, $100 billion in 3 years, by far the largest amount in that time period. We've seen record job growth. Virginia went from bottom third in job growth to top 3, 5, 10 every year in job growth. And that has allowed us to run surplus after surplus after surplus. The net of that is that we have open jobs in Virginia, 250,000 open jobs for folks to take. But on top of that, our economic development pipeline has been as full as it's ever been. And we're seeing businesses, international companies, want to come to the United States. We're viewed as the top state in America for business, and they want to come to Virginia. And so that's a really good foundation for us as there is a period of disruption. But I think there's a long-term opportunity, and I think Virginia will really do well.
We can talk about the long-term opportunity in the fuller policy platform. I do just want to keep it on trade just for a moment. On trade, the methodology, it does feel like, was pulled from a hat in the last few weeks. And the criticism we hear around this table quite a lot. They will acknowledge the problem, and they will acknowledge that the president has articulated that consistently and well over the period of decades, not just weeks and months. It's the remedy to that problem. At the moment, what we hear from the bank CEOs, from investors, is this economy has drifted into a wait-and-see moment, that they aren't going to make those big CapEx decisions until they really know the rules of the game, the rules of the road. Do you think we'll know the answer to that within 90 days?
I think we'll see a lot of clarity over the course of the next, now 80 days, I guess, or 82 days.
I'm losing count.
But the net of it is that President Trump was clear. He's continued to be clear that in resetting bad trade deals over the last decades and reestablishing reciprocal trade opportunities, by the way, with nations that are our allies, China's a whole different topic, but with nations that are our allies, we just need fair trade, and we haven't had it. And so, to reset those trade imbalances, you see him do what he does well, which is create space for negotiating. And I think that's exactly what's happening. When the first weekend after April 2nd, you read in every publication that 75 countries had called within a day to start the negotiations, and you've already seen those negotiations, at least reported in rumor. I think this will be this opportunity to take a big step in resetting this.
Hold on a
and
second.
I think that's what the market needs to see.
Part of the problem, I think, and you know this very well, having invested heavily as a co-CEO of Carlyle and been investing in infrastructure, which takes a long time. There's a maturity mismatch between when some of this negotiation is happening, when these tariffs go on, and how long it takes to bring that investment to the United States. There is a lack of clarity about whether those policies will be continued in perpetuity, and it's leading to paralysis at so many companies. What do you tell the companies in your jurisdiction who come to you and say, how can I plan? How can I hire? How can I invest when this could change, when I don't even understand the parameters we're talking about?
Yeah, I have to disagree with you on the long-term planning, because we're seeing a pipeline of economic investment that has been as full as it's ever been. And these are long-term investments. Fortune 50 companies wanting to build in America and in Virginia, hopefully, if we can recruit them there. And these are long-term investments. And you saw NVIDIA yesterday talk about $500 billion. We've seen most of the big pharmaceutical companies commit to building in the United States. We're seeing technology investment, advanced manufacturing, all in the United States. These are long-term investments. I think the difference in a lot of people's understanding is that during market ups and downs, well, yes, IPOs get postponed, and yes, corporate deals get postponed. But these long-term commitments are actually coming in very large numbers, and that's good for states like Virginia. I mean, listen, we're in the SEC of economic development. I compete every day with Tennessee and North Carolina, South Carolina, Georgia, Florida, Texas, and we've got to compete. And I think that much of that investment will come to this region, and that is a long-term commitment. And so the uncertainty in the near term, yes, I get it, I understand it. But the long-term expectation that America is going to be the best place in the world to invest is clear and real. And that's what we're seeing in our economic development pipeline.
There's also an issue of staffing all of this up and how we do this when not only is there a maturity mismatch, but also potentially a skills mismatch. And I know that your state has been significantly affected by some of the DOGE cuts, and you've talked about that and how you plan to provide for some of these workers. But how do you reskill people to work for different types of jobs, given that they've worked in a very specific field and there might not be jobs in that field, and what we're trying to build up hasn't been there for a long time?
Well, first you go to work and prepare an education and training ecosystem to do exactly that. And we've been doing this for the last 3 years in Virginia, which is resetting the career paths and the education paths for lots of Virginians with opportunity. And today we have an incredibly high labor participation rate. It's bounced back from lows during the pandemic and the previous administration to near one of the national highs. We have one of the best workforce training programs in America. We were just named for the 3rd year in a row of having the best customized job training program in America. This is what you do. You go to work. I do think that the expectation that there will be job losses, particularly out of the federal government, is real. We haven't seen them yet that much in Virginia. I mean, our first-time claims and unemployment are still at historic lows. But listen, I do think that the federal government's downsizing is necessary. Listen, we're at $37.5 trillion of debt, $2 trillion a year of incremental debt. We can't do that. And so resizing the federal government and recognizing fiscal responsibility is critical to the future of the country is real. What does that mean in a state like Virginia? We have a lot of federal workers. A lot. Now, a disproportionate amount of those are in the defense and in the intelligence and national security area, and we're seeing more money go into those areas. but I still expect that there will be real disruption for some folks in Virginia. My dad lost his job twice when I was growing up, and I've seen this in families of my own, and it is really hard. And that's why a pathway to a new career is so important. Because of our economic growth, we have 250,000 open but unfilled jobs in Virginia. And over 100,000 of those require a bachelor's degree. These are good jobs, but they're also jobs that pay well. And so opening up that pathway to folks who find themselves with job loss is really, really important. And so we launched something called Virginia Has Jobs. And it's for folks to get jobs in Virginia from all over the country. But at a time when we're seeing this dislocation from the federal government, it's a real opportunity pathway. 250,000 jobs, pathways for training, coaching, resume writing, but also for making sure folks know how to file for unemployment and keep their health care. This is a pathway that I'm really hoping that people who do have job disruption can find a way to a great career in Virginia, because Virginia has lots and lots of jobs, and people can go to virginiahasjobs.com and actually find one. And that's part of, I think, this movement of really public sector employment to private sector employment. And we've seen it in Virginia. We've had great job growth over the last 3 years. It's led to record surplus after surplus after surplus, which has allowed us to reduce taxes. It's allowed us to invest in education and in law enforcement. And by the way, in economic development and job training. But it's also, I think, changed people's view of long-term in Virginia. We used to have, for 10 years, we had more people move away from the Commonwealth of Virginia than move into from the other 49 states. And last year, we became one of the top importers of talent in America. So this works. And at a time when President Trump, again, is trying to run a very, very full policy agenda, resetting trade, balancing the federal budget, making America dominant again in energy, reshoring manufacturing, and restoring this middle class, which has been eviscerated over the last 20 years, and doing all of that while deregulating to make America even a better place for business. I think we can look at Virginia and say, hey, we've seen at least a little microcosm of that, and it works.
Governor, the stakes are high. I'm pleased you mentioned your experience growing up. You, like me, we were professional dishwashers. You went on to have a fantastic career leading Carlisle, and now you're dedicating yourself to public service. There are now people much younger than us who believe that dream is not available to them, that upward mobility is no longer something available in the United States. And at the moment, as you know, filling stadiums around this country as left-wing people like Congresswoman Ocasio-Cortez, Senator Bernie Sanders, if this administration gets this wrong, we could see a swing in the pendulum all the way to the far left. It's not unthinkable. You can see that taking place. How high are the stakes? What happens if this administration screws it up?
Well, I first and foremost don't believe they will. And therefore, I think what people will see over the course of this administration is the realization of this long-term opportunity. And that's why all of the elements that in play are critical. You know, there are so many people in government who believe there's one policy solution, this magic wand that will fix everything. This is an incredibly complex economic transition model. And that's why having all of the elements in play at one time, while complicating, is critical, because they're each going to contribute for the long-term success. And if you peel out one, energy dominance. Listen, getting energy prices to a place where they're sustainably affordable at the gas pump and in the supply chains, critical. America should basically dominate the world of power and energy. Making sure we have a balanced fiscal moment, not running $2 trillion deficits, critical for the long-term success of America. Reshoring manufacturing, and think about what's happened over the last decades, where we watched critical, very high-paying jobs move around the world away from America and hollow out our middle class. That's the opportunity that has really been missing, because we've seen literally the middle class not participate in the economic growth of America over the past few decades. This is what this opportunity is all about. And I've said many times, I think the number one job we have as Americans is to help this administration be successful. And that success will translate into an even better America than we have today.
We've said it around this table. We hope they are. Just a final question. What's the future of Governor Youngkin? What do you want to do next?
Well, I finish up next January, and I just want to begin by saying this has been the most purposeful moment in my entire professional career, and I've loved it. And I want to make sure this last year is incredibly productive for Virginia. Listen, you only get 4 years in a governor's job in Virginia, and I've got 1 year left, and I got to get 4 years of work done in this year because we've had a great first 3 years, and I want to get a second term jammed into this last year. But I also recognize that there are a lot of folks who spend all their time planning for their next job. I'm not one of those folks. I'm going to spend 100%, if not 150% of my effort making sure that Virginia continues to thrive. We've got a really important election this year. Our Lieutenant Governor, Winsome Earl-Sears, has been a great partner for me through this entire economic revival in Virginia, and I want to make sure that she gets the baton. I think voters will trust us and trust her and want to elect her the next governor of Virginia, and then we'll decide what I do after I've watched her be inaugurated.
Youngkin Vance, 28.
I'll decide after I'm done in January 2026.
I had to try, Governor. It's good to see you.
I will repeat, though, the most important thing that we need to be doing right now is to be helping this administration be successful. And I think the elements are in place. It is a complicated set of movements in order to reset so many things at one time. But I have great faith that the long-term opportunities really are going to be great, and we're seeing that in companies who are investing all across Virginia and America.
For the good of this country, I think a lot of people agree with you. We hope you're right. Thank you, Governor. I appreciate your time. Thank you, sir. The Virginia Governor, Glenn Youngkin there. Thank you very much. With an update on stories elsewhere this morning, with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Bank of America and Citi rounding out the big bank earnings for the quarter with big trading results. Bank of America beating estimates on total trading revenue and net interest income. Citi, for its part, delivered better than expected sales and trading revenue as well, moving closer to its profitability targets. Elsewhere, China has ordered its airlines to stop taking deliveries of Boeing jets. Sources tell us that Beijing also asked carriers to halt purchases of aircrafts, related equipment, and parts from U.S. companies. The Chinese government is also considering ways to assist airlines that lease Boeing jets and are facing higher costs. And it's day 2 of Meta's antitrust trial set to kick off today. Federal prosecutors are looking to prove Meta bought its way to a social networking monopoly. Mark Zuckerberg took the stand yesterday for more than 3 hours, testifying about the company's 2012 purchase of Instagram. He's expected back today. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Up next on the program, we'll set you up for the day ahead. Plus, we'll catch up with Krishna Memani of Lafayette College. From New York City, this is Bloomberg. Equity futures on the S&P just a touch softer. We're down 0.25%. Coming up through the week, this is what it looks like at 2:30 p.m. Eastern Time later on today. President Trump signing executive orders. Then United Airlines results coming after the closing bell tomorrow. Retail sales and Fed Chair Jay Powell speaks. Thursday, an ECB rate decision plus another round of jobless claims before we get earnings from Netflix. Joining us around the table for final thoughts and a look ahead to the trading day, Krishna Memani of Lafayette College. Krishna, good morning to you, sir.
Morning, sir.
I remember a number of months ago and you said you don't want to be in stocks, you might be better in bonds. What now?
I think it's still the same. That is, the reason not to be in stocks is because the upside is limited. That is, they're not cheap. And on top of that, you face all sorts of economic and actually existential uncertainties. In that environment, expecting it to kind of go back up in a meaningful way, I think is just not realistic.
How much do you buy into this idea that Sell America is the trade and it's going to stick around for a long time?
Well, so, yeah, there are a whole bunch of people in this world who would like that to happen. But I think the real question is, how likely is that? And I think if you kind of evaluate that, then, OK, they don't want to be here. Where else do they want to be in? It's not that Europe is lighting a fire or even some of the emerging markets away from India are that superlative. So I think this is a good thesis, but I don't think it'll work out that way. If the U.S. markets don't do well, other markets may do somewhat better on a relative basis, but on an absolute basis, expecting them to do meaningfully better on in positive returns, is not in the cards.
That said, we've heard so many different analysts talk about the possibility of stagflation. How do you rearrange your outlook longer term and your asset structure based on that type of discussion of a stagflation in the United States?
So I think Waller kind of hit the nail on the head yesterday, which is he brought in the transitory word that nobody likes. But I think the key point that he was making was that, yes, tariff will lead to a higher price level. but not necessarily inflation. And I think that's realistic. That is, in a really bad scenario, the most likely outcome is that we go into a recession. I think expecting inflation to remain meaningfully high in that environment, given the structure of the economy, it's a possibility. I wouldn't bet that as a significant probability.
Rude question. Is Governor Wallace saying those things because he believes it's right for policy or right for his career and his next move?
No, not at all. I think if you look at it, it's a really fair question. And I would say that based on all the things that he has said on a consistent, I have a great deal of respect for him to be saying these things in the middle of all of the stuff that is going on. I think he truly believes it. And I think he's thinking of it as an economist as opposed to a politician who wants to further his career. And I think he's being very truthful.
Is it easier to say when the rest of the committee is out there prioritising anchoring inflation expectations?
Well, so I think the rest of the committee is thinking about in certain ways. And I think it is important for us to hear Waller's viewpoint, because I think from a doctrine standpoint, he probably carries more weight in that committee than anybody else. Everyone else is, they're significant theoreticians, but I think Waller has a great deal of credibility based on what the outcome has been based on his forecasts over the last few years.
A phrase Lisa and I have heard repeatedly through the morning: calm before the storm. This is calm at the moment relative to last week, certainly the calm after the storm. Do you think this is the calm before the storm again? And is the storm in the data?
Well, so that's actually, again, a very good question. I think the likelihood of us seeing the sort of storms that we saw last few weeks, since Liberation Day, I guess, I think I would assign low probability to that, because the moment that starts happening, you anticipate some sort of a policy initiative. So it's like the Fed put in a different context. Government put as opposed to Fed put in that. But I think what we are actually going to see is probably slow deterioration in the growth trend. Not a catastrophic drop, because there's enough momentum in the economy, but a slow deterioration that will probably manifest itself in the second half of the year rather than during the summer.
And Lisa, some people think that process has already commenced, already started.
Which is the reason why, even though there's been a pivot or some sort of past of the uncertainty, people are still baking in that chance of some sort of downturn.
Krishna, it's good to see you.
Thanks
for dropping by. Krishna Memani there of Lafayette College. Equity futures a bit softer here. We're down by 0.2%. Coming up tomorrow, Jack Caffrey of JPMorgan Asset Management, Alicia Levine of BNY Wealth. We'll catch up with the former House Majority Leader Eric Cantor and the United Airlines CEO Scott Kirby. From New York, this is Bloomberg.